15,000 miles. Tesla is aiming to officially launch its robo-taxi service this June. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara later on in the next hour. Things are pretty fluid. Things can change. Just to bring you the latest reporting, this from ABC, that the Trump administration is considering possible exemptions for some Chinese auto parts, according to their reporting so far this morning. More on that a little bit later. Up next on the program, Europe's wake-up call.
We are in a stagnating situation. So stagnation is the picture for this year, maybe recession. Europe has to stand together in these complicated times. Cooperation is key in these days.
Up next on the program, the ECB chief economist, Philip Lane, live from Washington, D.C. this morning. Good morning.
Behind the bright lights and adrenaline of pro sport is an equally exciting world of negotiations and deal making.
That's what we cover each week on our podcast, The Deal.
I love the fact that you have, we say the cojones, but I can't say that in Bloomberg.
Maybe moxie?
Yeah, moxie. I'm Alex Rodriguez, former baseball player turned business executive.
And I'm Jason Kelly, a journalist at Bloomberg. Over the next couple months, we'll hear from all-stars like Billie Jean King.
Well, what should I learn? What should I do? I said, learn the business.
Jay Williams.
You're an asset, but how do you become the principal?
Paul Rabel.
We're going to be the league of digital, and that's why you're going to invest.
Adina Friedman.
I definitely am competitive.
David Rubenstein.
People don't come up to me on the street and say, let's talk about this private equity deal you did recently. No, nobody does that. They say, let's talk about the team.
And so many more.
You need a clap?
No, I think we're ready. Go.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Two days of gains on the S&P, taking a little bit of a nibble out of that rally this morning. We're negative by 0.3%. No real drama, though. On the Nasdaq, we're down about a third of 1% also. Under surveillance this morning, Europe's wake-up call.
We are in a stagnating situation. So stagnation is the picture for this year, maybe recession. Europe has to stand together in these complicated times. I will use these days here in Washington, D.C. to get a better understanding, to convince the partners here that cooperation is key in these days.
So here's the latest this morning. The ECB warning tariffs may be more disinflationary than inflationary for Europe. This after President Trump said he's confident of reaching a trade deal with the EU. Joining us around the table here in our studio in Washington, D.C., the chief economist of the European Central Bank, Philip Lane. Philip, it's good to see you, sir.
Good morning.
Thanks for being with us here in Washington. So the Governing Council meeting, I imagine, was very different this time around than a number of months ago. When you walked into that room and presented changes to the economy, what did you tell the team?
Sure. I mean, I think it was a gear change for several reasons. So, of course, our core business has been to try and get inflation back down from a high number to our target. So I think there was a milestone in this meeting in the sense of the most recent data had come in quite low. We'd been waiting for services inflation to kind of drop, and it has been dropping. And then we had surveys showing that basically the wage dynamic this year and in 26 is lower than we expected. So basically, if you like, if you clear the table about the historic issue, are we safely bringing inflation back to target? I think it's not entirely settled, but a lot of it is settled. So the gear change was, of course, now we have new things to talk about. And really, since all the way back to last summer, trade policy uncertainty has been part of what we've had to talk about. But we still have trade policy uncertainty, but we also have trade policy news. Lots has happened. And then the other element of what we've seen is, of course, and that happened, by the way, like a day or two before our March meeting, was the German breakthrough on fiscal policy.
Yep.
So we already had that, if you like, in the early incarnation at the March meeting. We know more now, but it's still, in terms of what the other European countries are going to do, it's something that's still in discussion. So what I would say, if you put all of that together, and I think you're probably hearing this from various colleagues and other people this week, is if I take a longer-term perspective, and the IMF in their publications this week, a lot of the data go out to 2030. If I take a 2030 perspective, I think there's a lot of grounds to have a renewed optimism that essentially with more fiscal support, the credibility of delivering our 2% target on a kind of long-term basis is stronger. The case for the European economy to be more resilient, to grow from a domestic source, not just from running a big export machine, is more credible. But of course, we have to navigate from where we are now, where, as you said in your intro, immediately in the short term, the way it's playing out, with euro appreciation, with a big drop in energy prices, the disinflationary forces are there. But I would say maybe, I wouldn't load it all onto trade policy.
Sure.
Because what we also see now is a portfolio shift. So there's a clear portfolio shift going on, which is, I think, the way you can reconcile euro appreciation in the middle of this trade discussion.
As you know, Philip, that sort of begs the question why you don't act more aggressively. Does that give you the space to act more preemptively?
Well, I think a very important narrative we had last week, and it was repeated throughout the monetary policy statement, was resilience. What we're seeing is the European economy growing. 2 years ago, it was kind of more stagnating. So we said the European economy is going to recover. We saw, modest but still market recovery last year is around 0.9. We have 0.9 written down in March for this year. And that's basically because with incomes going up, consumption should recover. With our monetary policy and the general improvement in the economy, investment should recover with more government support. So all the domestic engines are there. So what you have to think about is all of that, if you like, is saying the economies should be growing, even marking down some trade negative. And this is why we're not in a situation where we see some dramatic change in the external environment or in price pressures and so on. So steady is okay, I think.
Hold on a second. Are you saying that what we've seen with respect to U.S. policy and the uncertainty isn't increasing the chance of recession materially for the euro region?
Well, I mean, I think our overriding theme, of course, is uncertainty, and let's not get ahead of ourselves in terms of being too sure about any path for the economy. But I think the message is, but it's, not me dreaming it up. If you look at the external watchers, if you look at the IMF, it's fairly modest markdowns on the growth rate for the European economy. The US, of course, has a major trade policy issue with the world. We have a trade policy issue with the US. The US is an important trading partner, but it's not our only trading partner. So directionally, it is a markdown. There is a markdown, but it's important to say it's a markdown from a growth rate around 0.9 to a little bit less. Let's see in the coming weeks how much less. And I think if you look at the surveys this week, the surveys have elements of people being concerned, but they also have elements saying, right now we're busy. Manufacturing is a bit busier than it was. That could be a little bit of front-running of tariffs, for sure. But it's also, remember, the recovery narrative. Europe has been stagnating. The American economy has grown quickly. So if you like, in terms of if there was room for the American economy to decelerate and then trade policy is adding to that, what I'm saying to you is essentially the baseline for Europe was to grow a bit more quickly. And so the resilience is there. You can take a trade hit without going to using that word, which that you mentioned.
You mentioned, of course, that Europe has more trading partners than the United States. How concerned are you that if the walls keep going up in the United States, China will have to just dump somewhere, and it's going to be on the continent?
So I think directionally an element of that must be expected. But I think China fully understands that if you listen to their policy announcements, they're going to their focus is on improving domestic demand. So in terms of the reorientation from the US, I would allocate a fair amount to domestic demand, some amount to around the world. But I think also China understands it's a large economy and a bit of restraint in exporting may make sense.
Philip, I've got 20 seconds left. I just wanted to jump in. Ollie Rehn was busy this morning, your governing council partner, and he made the point that we should be open to larger interest rate cuts. Is that a position that you and the team agree with?
Philosophically, we don't pre-commit to any rate path.
Of course.
And so this is why, again, it's important, and I think the governing council, tries hard to maintain this, is you can express that in different ways. And in particular, there's no reason to say we're always going to do the default 25. Philosophically, I agree with that. Okay. But what I said to you earlier on is right now, the growth performance, I'm sure to be marked down. But it's still a growing economy. We have inflation, I think, to the downside. But we don't need to be too dramatic about it.
Philip Lane, the chief economist of the...
Literacy is a big problem in the United States. I think 14% of adults are functionally illiterate, which means they can't read past the 4th grade level. That's a large percentage of the population. Nothing the Library of Congress can do can completely solve that problem, but are you surprised at how many people still cannot read in this country and how many people have another problem called illiteracy or illiteracy, right, which means they can read, but they don't choose to read?
It's a challenge with the digital age because people they're reading on tablets, so we do count that as reading. If you have an e-book, you're reading the book, and I've been often asked if I'm listening to a book, are you reading? Does that count? But there is a concern that the amount of reading, actual text that people are doing, is diminishing. And so how do you work with other organizations? So the Library of Congress connects to public libraries, school libraries, and we do joint programming with them.
Why do we actually have all these thousands of libraries anymore when people are often doing things digitally and they don't need to go to a physical place to get a book?
People are using public libraries and someone has said, as opportunity centers. And libraries are offering collections that are beyond books. So libraries are circulating and responding to communities in so many ways.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
what is the issue between the type of information that's being collected by investors and the marking issue that you're describing?
But what mark-to-market assets do is it forces honesty into the situation. We're talking right after the DeepSeek model surprised everybody in its efficiency. It took hundreds of billions off of market caps because it legitimately raised concerns that maybe the future of AI was different. I guarantee you that if you look at other portfolios that aren't marked, they didn't move. If private assets are going to eat the world, as they say, with the equity market halving in the number of names, you come to a world that is increasingly an echo chamber. Imagine you have a firm that has some public assets and some private assets. If you see your public assets in AI going down by 20%, you're going to be thinking very, very deeply about what your private assets are worth differently than someone who just has the latter.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
If these policies and these tariffs stay in place, then we will have a recession with a very high probability.
The president only gets out of this if he, in a credible way, commits to self-limit.
I don't know that it's too late to pull out of that swoon, but we've been getting pretty close.
The sentiment data has been absolutely abysmal, but it really hasn't had any material effect on the hard data.
I'm optimistic in the longer term about the U.S. economy.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from the nation's capital this morning, good morning to you all from Washington, D.C. The IMF World Bank spring meetings well underway. The third hour of Bloomberg Surveillance starts right now with equity futures on the S&P 500 slightly softer following two really good days of gains on the S&P. 2 days of gains totaling more than 4% on the benchmark in the U.S. Equity futures on the NASDAQ down by about 0.1% this morning. No real drama, and no drama in the bond market. That is welcome news. In the bond market this morning, yields lower for a third consecutive session. The 10-year down by 4 basis points. 4.34. The bond market's had its moment. The bond vigilantes were shouting and screaming over the past few weeks. This week, corporate America is having its moment. We've said repeatedly on this program, potentially the most important meeting that took place this week, not at the IMF, not at the World Bank, not between ministers, but between the President of the United States and the biggest retailers in this country, Home Depot, Walmart, Target, making a case that in the next few weeks we could see higher prices and fewer goods.
The fact that he listened to it, the fact that A, he had an audience with these executives, and that B, he saw some sort of shift in tone, is sort of hope, giving more hope to markets that are only down some 5% now from April 2nd, Liberation Day, that maybe he will reverse course. It is difficult to put this away, though, given the uncertainty in markets and given the fact that ultimately companies still don't have a concrete sense of what they can expect ahead.
Corporate America is painting this dark picture of supply chain disruptions, higher prices, empty shelves, all going into back to school time. And then, of course, at the end of the year, the holidays and Christmas. And obviously that shook the president a bit. That is one key meeting I was told that was very important this week, beside the fact that Secretary Besson has been more of the vocal individual part of the cabinet going out and talking about trade. It also comes at a time when I go back to this Reuters Ipsos poll released yesterday, the lowest marks the president has received since his first administration as well when it comes to his handling of the economy. He promised everyday Americans to bring prices down. And corporate America is saying we can do that, but not with these tariffs.
And based on the words so far this week, he appears to be responding to that. But based on the actions, no change just yet. We still have the tariffs we had last week and the week before on a range of countries, including China. What we've heard from the likes of the Wall Street Journal is that maybe those tariffs will be reduced by as much as half on some goods. What we heard from the Treasury Secretary is something that a lot of people were waiting for, that they won't do this unilaterally, something Reuters reported yesterday afternoon as well. The president is still going around and saying, though, if you don't come to the table, we will do things unilaterally, will decide the tariff.
Yeah, I don't know what he meant by that. Maybe there's a chance that he meant in the next few weeks they could see the rate go down just because of all he's hearing about from corporate America. I view the whole situation circular. The president promised on the campaign trail 10% tariff wall around the United States, 60% on China. The Wall Street Journal is now reporting that they're thinking about just dropping it to where he promised it a year ago. The problem is we've had a ton of disruption in between.
You've made this point repeatedly, and consensus is starting to build around that view over the last few days. Equity futures right now in the S&P just a touch softer. We're down by 0.2%. Coming up this hour, Franklin Templeton CEO Jenny Johnson following back-to-back gains for equities. We'll catch up with Carlos Cuerpo, the Trade and Economy Minister of Spain, on a US-EU trade deal, and the Standard Chartered Chair, Jose Vinales, on the potential for lower levies on China. We begin this hour with stocks lower as investors await clarity on trade talks. Jenny Johnson, the CEO of Franklin Templeton, one of the world's largest investment managers, joins us now for more. Jenny, it's good to see you.
It's great to be here. Thanks for having me.
Things have changed a lot since we caught up with you in Davos, Switzerland. There's a lot of optimism. You remember it. Everyone was charged
U.S.
up.
exceptionalism.
Bullish growth, lots of hiring, markets are great. Things have changed a lot. How have they changed for you?
Well, we talked about it at the time. I think that you have to think through kind of where the president is, right? He's come in with a plan, and he's been very clear, right? It's taxes, immigration, tariffs, government efficiency, and deregulation, right? And he has about a year and a half to get those things done before the midterms come in. And so, from the tariff standpoint, again, he's a deal maker. So when you are trying to make a deal, you need to show that you are in the position of strength, right? So a lot of this blistering is around, I'm in a position of strength and you're going to have to bow to my will. I think the challenge has been there are some unintended consequences of that. I was talking to somebody yesterday about Canadians. They're not upset about the tariffs. They're upset about the 51st state comment. And that Airbnbs in Rhode Island are down because the Canadians say, I'm not going to come visit the U.S. So those are the unintended consequences. The other piece of this is he needs the tax revenues identified in tariffs to help fund his tax cuts, which, by the way, are not tax cuts, really. They're extensions. And if we don't get that extension, there is a massive tax increase that happens, which really becomes an issue around the economy.
Can you describe how you and the team think the end game looks like? What do you think it looks like? Because some people have described the last few weeks as madness. Is there a method to it?
Yeah, so I think what we hope to see, right, you'd like to see a couple of deals done, right, to show that he's willing to come to the table and make a deal, right? So if we can see a deal with Japan or Vietnam or, somewhere to show, no, he's playing his deals. You'd like to know who is responsible. Remember, it was Paul Ryan who ushered the first tax cuts through. Like, who's responsible for ushering that legislation through and championing that? That'll be very important because he's got to get those done. And the question is, how quickly can he get it done to calm the markets? Because what we've seen is, look at you, when you suddenly have CEOs who say, I can't give guidance because there's so much uncertainty, that uncertainty makes them fear, and then they stop making investments. If you stop making investments, it slows down the economy, right? So I think what we need to see in the next 90 days is some clarity.
In the meantime, uncertainty leads to a lot of conspiracy theories and lots of other types of speculation. As someone who oversees $1.5 trillion of assets, how much of a material shift have you seen with customers, consumers, shifting just slightly away from U.S. assets to insulate from some of the whipsawing and the uncertainty?
You definitely see non-Americans reducing on the institutional side some of their exposure to U.S. equities. Okay, so we've seen that a bit. But on the other hand, you sort of, if you are in the market now, this is not the time to get out of the market, right? You need to play this out. And if you hadn't made the trade to being in more defensive stocks, then there's no point in doing that now, right? Because you've already sort of missed it. So, the reality is AI. I actually played around this weekend with an app called Replit, where you can just use natural language processing to have it code and generate an app for you. Like, the efficiencies that are going to come from AI, we haven't seen those kind of productivity gains yet. The productivity gains that we're seeing are coming from technologies that came out 20 years ago. And so as those things play into companies, I think you'll see real opportunity.
One thing that I hear from you, and I heard from Mike Wilson of Morgan Stanley earlier this morning, was that corporate America has a lot of good about it in terms of strength, in terms of resilience, in terms of technological progress. It's the question about other dollar-denominated assets, and I'm talking about treasuries. I'm talking about government debt, especially given some of what you were talking about with respect to who is driving some of these budget proposals through Congress. That really is the issue. How much have you seen that bid get called into question as institutions, particularly foreign ones, move away?
Well, I think there's a question of, how much are, foreign governments pulling away from treasuries, and, is that what we're seeing in the treasury market, or are we seeing the unwinding of the basis trade? And so, look, then the question falls into, well, is the U.S. as the reserve currency a question? Look, where else are you going to go, right? The U.S. is going to be the reserve currency. People will say, well, China trade has gone up 50%. Yeah, it's gone from 4 to 6% of trade, right? It'll chip away at it, but we are still going to continue to be the reserve currency.
You mentioned a lot of non-U.S. investors pulling back from the United States. Morningstar had research out this week that said some of that is actually patriotic rebalancing from capital from America to Europe. Do you think it's that emotional for some of these people?
Well, just again, talking to folks from Canada who are so fundamentally offended by the comment of, the 51st state, yeah, it's emotional, right? They kind of get it on the trade and tariffs, and we can deal, and you want help on immigration, but a comment like that has obviously had that kind of nationalist response.
What are the long-term impacts of feelings like that?
Listen, I was at a dinner last night. We were, debating, does that push Europe to China? No, I don't think it, obviously, I think what it does is there's the joke of, it's not MAGA, it's mega, make Europe great again, right? It forces Europe to do things like more defense independence, more energy independence. Look, there has been a lot of brilliant talent in Europe. Why are we not seeing these unicorn companies from a technological, and a lot of people would say it's the regulation and it's some of the policies that they have in Europe. And so if this forces Europe to be more resilient on its own, that's actually a good thing for Europe. I don't think they don't suddenly trust China much more. They're already trading with China, but it forces them to say, you know what, we have to stand on our own a little bit more.
It's why we've seen some investors rebalance towards Europe since the start of the year. I wanted to build on some of Lisa's questions, and I think this is an important line of questioning. At the moment, some investors aren't drawing a distinction between risk assets in America and the safe haven asset in America. It's trading as one bucket, dollar-denominated assets. And I wonder, from your perspective, when that EM dynamic starts to take hold of a country, whether that's a risk you need to actively manage or a dislocation you take advantage of. Which one is it at the moment?
Well, I think anytime that it becomes a risk-on, risk-off in a big block, and yet the underlying fundamentals are different in kind of an investment, that actually becomes a great investment opportunity. So I think you have to look at it and unpack those.
Do you think that's what this is right now? And is the opportunity in stocks or bonds with that in mind?
I think, right now it's almost a market reacting to just a headline statement, right? And so it's really sort of on and off. It's a risk on, risk off. I think that from the dollar was some would say overvalued, who knows, right? And it's come down a fair bit. I think there are a lot of people that were the U.S., the debt and the deficit, thought that it was overvalued. And so probably in this, there's a little bit of that coming, some of that frothiness coming off.
What's your advice to people right now who were part of that dollar bid? They've built up that massive dollar long over the period of a decade across asset classes in both equities and fixed income, and they're nervous about the policy in Washington and looking to reallocate. What are you suggesting they do? I
think it depends on where if you're a dollar-based economy, I think that's okay. You don't have to worry about that. If you're not a dollar-based economy, you have to understand how that's going to impact your investments.
Certainly been something the Europeans have had to think about over the last few months, that's for sure. Jenny, it's good to see you. Lots to talk about. I can't imagine how much has changed the next time we speak. Jenny Johnson there, the Franklin Templeton CEO, on the latest in this market. Lisa, important considerations for anyone trying to manage a portfolio at the moment in 2025?
There's some big existential questions that a lot of people are saying, well, if you look at the companies, they're still producing all of this. A bigger question comes, the companies can be doing really well, but if you have currency risk and you have potentially fiscal risk or debt risk, that changes the equation, and that, I think, is the unknown.
The dollar a bit weaker again this morning. Euro dollar at the moment, 113.76, but some comfort in the bond market. We've said that repeatedly. Yields lower for 3 consecutive sessions. We're down 4 basis points now on a 10-year. With an update on stories elsewhere this morning, with your Bloomberg brief, let's cross over to Yahara Hackers in New York for more. Hey, Yahara.
Hi, John. We start with shares of Procter & Gamble falling about 0.9% in the pre-market after the company cut its annual sales and profit outlook due to tariff uncertainty and volatility in consumer demand. P&G CEO said the company will likely roll out price increases during its next fiscal year, which starts in July, saying tariffs are inherently inflationary. Meanwhile, President Trump plans to celebrate the 100-day milestone of his second term in Michigan next week. Trump will highlight his tariff policies that he says are protecting blue-collar workers. His 25% levy on autos and auto part imports have been praised by the United Auto Workers Union. And Louis Vuitton raised the price on one of its most popular handbags after President Trump imposed 10% tariffs on EU goods. Analysts at Bernstein say the Neverfull GM bag in the classic canvas now costs $100 more, totaling $2,200. They said other U.S. handbags prices rose by 3.6%, but that not all products were affected, suggesting some may be made in the U.S. That's your Bloomberg Brief. John?
Yahara, thank you. Thank you very much. Any excuse, right?
Any excuse, I guess. Although that handbag, the Neverfull Louis Vuitton handbag, you can go find at a lot of secondhand vintage shops.
Oh.
So you can get even better prices.
Or a visit to Canal Street. Is that still a thing?
I think so.
Down in Soho, maybe. All right, up next, the Morning Calls Plus. Carlos Cuerpo, the Trade and Economy Minister of Spain, on a US-EU trade deal. That's next from Washington. This is Bloomberg.
Is going to be the consequence for U.S. markets?
We're basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
David Weston, join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today, and what will likely be the headlines tomorrow.
Above all else, it's emissions.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Equity futures on the S&P 500 negative here by just 0.1% on the S&P. The opening bell is about 1 hour and 13 minutes away. The Nasdaq just about turning positive. Let's get you some morning calls. First up, Barclays lowering its price target on Southwest to $26, pointing to uncertainty as the company drops its 2025 forecast. That name is down at the pre-market by 3%. Your second call from Deutsche Bank cutting its price target on Meta to $6.50, saying tariffs threaten China's ad spending. Just a little bit softer there by more than 0.1%. And your third and final call from Bank of America cutting its price target on Apple to $2.40, citing increasing tariff uncertainty and delays in its AI-enabled Siri. A stock just slightly negative going into the opening bell. That's the price action and some morning calls. Let's turn to trade negotiations. Spain's Trade and Economy Minister, Carlos Cuerpo, signaling optimism about a US-EU trade deal after meeting with the Treasury Secretary, Scott Bessent, just last week, saying the talks were useful and constructive. Carlos joins us now for more. Minister, it's good to see you, sir. Thanks for being with us.
Of course, my pleasure.
Did you get an understanding of the ask? That seems to be a question we've all asked many times this week in Washington. Did you get a decent understanding of what they'd like from Europe?
That's actually when you start a negotiation, those are the initial steps in which we are actually living now through these negotiations. You know that these negotiations are led by the European Commission, Commissioner Šefčovič, We will also, on a bilateral basis, be engaging with our U.S. colleagues, trying to get a feeling exactly of what their asks are and how we can manage to get to a fair and balanced deal, which is what we all want, I think.
Are you expecting a blueprint in the meantime before the 90-day reprieve is up?
Well, what we can expect in 90 days, I think, is an agreement in principle or a way forward to be able to actually then pinpoint the details of where this agreement would go. But there is time to reach this agreement in principle and to lay down a way forward which would lead to, as I said, a fair and balanced agreement. Because in the end, while we're negotiating, some or most of those tariffs for European companies are actually still in place.
When it comes to, are the Europeans on the same page, though? You and a few other countries have decided maybe we should have the digital tax. Giving that up could be a bargaining chip. Is that still on the table right now?
Well, I mean, this was part of a decision that came within the OECD context, where we decided that basically those big digital firms that were providing services in our countries were not getting taxed in a fair manner because they were extracting those rents from the data that came from our citizens, etc. So as part of this OECD big deal, we decided to go ahead with this digital services tax, which is, I think, a fair and balanced tax that helps also run the public finances of our countries.
So at the IMF meetings, there's kind of a dismal tone among a lot of people. You walk in with a pep in your step. You're one of two economies that actually were upgraded in terms of the outlook at the IMF. What's going on? Why is the Spanish economy outperforming so significantly at a time when everybody has a great degree of uncertainty?
Well, it's great to add some note of optimism in these meetings, and it's good that Spain is actually leading the way in terms of good prospects and strong growth momentum. I think that's the key. Also, the IMF went this way. Spain has been outgrowing our main partners for the past few years, and this is also the way that it is expected to be in 2025 and 2026. For the second year in a row, in 2025, we will be the major economy that will be leading in terms of growth, and this is, I think, a great structural change for Spain.
A lot of my friends, family, have all gone to Spain recently, and I wonder how much this is part of it. Sort of U.S. travelers coming and vacationing in Southern Europe at a time when the dollar was strong, and now suddenly how much that's at risk of dialing back really significantly, given that the dollar seems to be weakening.
Well, tourism is part of that positive story. We've been reaching record numbers in terms of tourists, but it's not the whole thing. When we look at services and exports in services, the lion's share is about non-tourism services. Around 100 billion is services to firms like, of course, IT services, accountability services, accounting. So all of this is part of the success story of our external sector. And it's, as I said, 100 billion in exports versus 93, 94 billion in tourism. So that's the modernization story and the structural change that is actually happening. And what we expect in terms of tourism is still a very strong year in 2025, despite, as you said, a weakened dollar.
Minister, your Prime Minister has met with Xi Jinping recently,
yes,
the Chinese leader. I wonder what kind of message you think that sends to the White House at a tense moment for the Europeans with the US.
Well, you know, this has been, this relationship between the EU and China, this resetting or somehow really getting to the sense that China is a rival and a competitor in many areas, but it has to be also an ally, a partner, a strategic partner going forward, has been going on for the past 2-3 years. And Spain is part of that, but it's an EU approach. And, you know, President von der Leyen will be in China also in, I think, in 2 months' time. And this is part of this, trying to reduce the deficit that we have in our trade relationship with China, sure, trying to open up the Chinese markets, trying to also attract Chinese investments to Europe. And this is, and let me then go back to your question, of course, very complementary to what we want to do with the US. So the EU wants to be a key relevant player in this new setup of geo-economic relationships, and we want to strengthen our relationship with the US.
You can see me smiling. I struggle to see how it's complementary to go and visit Xi Jinping at a time where the United States would actually like to see many countries isolate China. Were you asked about that this week?
Well, I've been asked a lot about that this week, but what I can say is that you can also listen to the U.S. administration say that they want to reach a deal with China, and we've been saying that the U.S. and China need to talk, and that would be for the benefit of everyone. So I think, again, both elements are very complementary.
It was the Prime Minister's, though, third trip in 2 years. There does seem to be more of an outreach when it comes to Beijing. And at the time, Secretary Bessent said you could do this at your own risk, cutting off your own throat. Do you feel like you have to choose between Washington and Beijing?
Well, again, I think the EU needs to be a key player going forward. And that means, of course, engaging with the major economic actors, be it China, US, or others. What we're trying to do is also a big outreach to other partners. We closed a deal with Mercosur, which hopefully we will ratify throughout the end of the year. And we're reaching out to India, to other Asian partners, to also the Middle East. That's the way forward for the EU. And I think the understanding that European Union is a stable, reliable partner is also helping us on the way.
Are you concerned, though, with the U.S. having these tariff rates up, that China will then put more of its products on Europe and hurt your own industries that you're trying to grow?
Well, that's exactly one of the risks going ahead, this trade deviation that we might actually see happen when the U.S. market is closed or let's say less open to other products, whether it will be a trade deviation towards the EU. We're monitoring that on a constant basis throughout, of course, all EU countries to see whether or not this is happening. We do not see it in the data yet. But, you know, an element which is important there is to engage with those countries that might actually whose companies might be sending their products towards the EU, including China. So this dialogue will be part, of course, of our outreach to avoid this trade deviation, this dumping of those products in the EU. We will be ready to protect our industries there as well.
The word you used referring to China was ally. And I think that might irk a lot of people in the United States because China certainly hasn't been an ally when it comes to the war in Ukraine. And the United States has continued to provide a security umbrella, particularly for the Europeans. And they're very upset about the fact that they're paying a lot of money to do that at a time where the Europeans have maintained trade relationships with adversaries. Where does that word ally come from to describe a relationship with China?
Well, I mean, as I said, we need to partner up with key strategic economic actors, and China is one of them. And this is the way that economic trade relationships have been going on for the past few years, not only between the EU and China, but also between the US and China. There are trade relationships that will be maintained irrespective of the political cycles. And we need to get this element of stability and certainty to our firms so that the whole system is actually working. And again, I think the EU is on a constructive, on a positive path towards engaging with all major partners.
Minister, appreciate your perspective this morning. Thanks for being with us.
Of course.
Thank you very much. Carlos Cuerpo there, the Trade and Economy Minister of Spain. Up next on the programme, we'll get you some economic data, jobless claims just around a corner, and some reaction from Jonathan Pingle of UBS. And then later, we'll catch up with the Standard Chartered Chair, Jose Vinales, on the potential for lower levies on China.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg. The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take 2 numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Some economic data just seconds away. All eyes on the labour market to see whether some of the tension in policy is beginning to show up in the underlying economy and start to give life to layoffs. The layoffs that we certainly don't want to see anytime soon. Equity futures going into that negative by 0.2% on the S&P. Virtually unchanged on the Nasdaq 100. In the bond market, things have settled down. Can we call it stability? 2-year, 10-year, 30-year yields lower by 5 basis points on 10s. Your 10-year, 4.33. With some economic data, let's cross over to Mike McKee. Good morning, Mike.
Good morning, John. It's almost like the magic 8 ball for economists. Initial jobless claims come in at 222,000, which is exactly what the consensus forecast was. Last week's revised up to 216,000. The continuing claims number, 1,841,000. That's down a little bit from 1,878 in the prior week. Durable goods orders, though, this is quite a shock. 9.2% gain. Last month was 1%. The forecast was for 2%. But I think what we've got here is a question about where the gains were. And my guess is we're going to see a big Boeing number. I've got to look into the actual data to find that. Capital goods orders, non-defense ex-air, that's the one that goes into GDP. Every month we talk about that. Up 0.1% as forecast. So it looks like we've got an outlier somewhere, and I'm going to guess that it is in the Boeing area and perhaps in automobiles. But I'll have that for you in just a second.
Mike, we'll come back to you when you have that data. Might be key there, breaking things down for you. Equity futures at the moment, not breaking down, doing okay. We're negative by 0.1% on the S&P. Joining us around a table here in Washington, D.C., I'm very pleased to say, is Jonathan Pingle of UBS. Jonathan, it's good to see you, sir. You've got to help us understand this moment. This data is so hard to read at the moment. It's difficult to know what is a pull forward and what is just a reflection of a resilient economy. Which one is it at the moment for you?
Well, I think one of the things we're seeing right now is just, every economy is going to have a certain amount of momentum. It's going to take time for some of the weakness to show up, particularly in the labor market. If you think about, the decisions that firms have to make, they're grappling with a lot of uncertainty. Their first knee-jerk reaction may not be cut now. It might be wait and see. And I think that was what we're seeing. We're generally expecting that the labor market data is probably going to look okay through the May data. We've been expecting that it probably will soften relative to March, but that it's probably not really until sort of June, July, August timeframe that we really see, the impact of some of the uncertainty and the tariffs on the labor market.
Do you think that we will see that impact regardless of what happens in terms of any resolution going forward? In other words, has some of the damage already been done?
Yeah, no, I think it has. This goes back to something Anne-Marie had mentioned earlier, where even if they're dialing back to kind of what was the upper bound mentioned on the campaign trail, which is actually still a lot of tariffs, right? And, when I marked down GDP growth this year by a percentage point, really partly because I don't have the crystal ball as to where the tariffs land. But if the bulk of these tariffs remain for the bulk of the year, the bulk of the economic damage is going to be done. And the economy was already slowing anyway. If we think about what consumer spending was doing coming into the year, the investment data didn't look all that great. It looked fine. Orders and shipments held up today. But overall, the economy was cooling already. state and local government spending was slowing, labor market was cooling. Now we're adding kind of a shock, and we can debate the magnitude, but I certainly think it's going to weigh on growth.
There's been this huge debate again between soft data and hard data, and will the soft data come up to the hard data, or the hard data come down to the soft data? Neil Dutta over at Renaissance Macro put out a really interesting point, which is a lot of the hard data is made look better than it has because of the bring forward type of behavior of trying to get orders and shipments before the tariffs went into effect. How much are you seeing soft data as having a much greater predictive power this time around than a lot of people are giving it credence for?
We have no idea. Okay, I don't mean to walk back your question. The soft data has been pretty terrible for forecasting in the pandemic and post-pandemic period. So I am kind of waiting around for the hard data, but I do think even with the pull forward, we can sort of see what's unfolding, right? We got a big jump in auto sales, people getting ahead of the tariffs, but I think that still signaled people were willing to spend money on cars. So the consumer was as much as it was cooling, it was sort of okay in March, and I think we'll have to see. But I think if you walk forward, even part of the price increases that we might see, if you think about what businesses are facing with the challenges in their supply chains, and for as much as the administration is carving out and walking back some of the tariffs, a lot of those carve-outs are only because they intend to tariff these products under other authorities, right? So this is a challenging environment, I think, for businesses in the economy, and I do expect it to feed through to the hard data eventually.
John asked a really important question yesterday. I was talking about my family being some of those individuals getting ahead of these big purchases. They're worried about prices going up, or are they worried about losing their jobs?
Well, I think you're starting to see a little bit of the latter. I mean, I think this started basically as people worried about the price increases and all the concerns we've had over the last few years over inflation. But I think you're certainly seeing, like when you look at the Michigan survey, for example, and the number of people who expect the unemployment rate to rise, I think you're starting to see that in surveys. People worried about their financial conditions, people worried about their jobs. And, we run some surveys of high-end consumers, and our softline retail analysts are starting to see some cracks even among high-end household spending.
So let's get into that, because that's important. The conversation we were having was basically, if you're worried about losing your job, you don't buy a car. But for many consumers at the moment, over the last few years, particularly the lower-income consumers, have been squeezed for quite a while. It's the upper-income consumers that have been robust and resilient and held up the aggregate numbers over the last few years, as you know very, very well. What kind of cracks are you seeing there now? And if we start to see some cracks there, some weakness, what would it mean for the broader economy? What's left?
That's exactly a point I've been trying to make. This is what the slowing coming into the tariffs kind of means. I mean, the expansion wasn't firing on all cylinders. I mean, upper income households were, carrying sort of a disproportionate weight in consumer spending. We've lost a lot of the impetus from the big wave of fiscal policy from the Biden administration. It was kind of a narrowly or increasingly narrowly driven expansion. If we lose those households, that's a meaningful impetus to growth. And we are seeing cracks in the surveys. Those are households that risk responding to lower equity valuations and a negative wealth effect. So I think that is actually one of the bigger concerns, is that this was an expansion that may have been vulnerable already.
So that vulnerability, how's it showing up at the moment? So we just had jobless claims still okay. Do you see anything to worry about the labor market and the real hard data at the moment?
No, the labor market's holding up pretty well. I would say, though, when I look at some of the forward details in sort of some of the job opening surveys we see, when we think about how low the hiring rate is, some of the incoming anecdotes on layoff announcements, hiring announcements, a lot of that really has weakened. And if I continue to walk forward where that's headed and economic growth continues to slow, I mean, I'm sort of a traditionalist, right? Labor demand is, function of product demand, right? So final demand is going to slow. I mean, I think labor demand is going to continue to slow as well here.
Wanted to finish on some final thoughts on the Federal Reserve and the independence of the central bank. I'm sure you've got lots to say. Given how they've set up the reaction function now, which essentially is to guarantee being late, isn't further tension between the White House and this FOMC just inevitable in the next several months?
We did a deep dive on that last summer, trying to sort of look ahead at these tensions. And I think, this is not a tension that's new to this White House and this Federal Reserve. But clearly the administration has some economic goals they want to pursue, and the Federal Reserve has other economic goals, and they may not be well aligned.
Jonathan, it's good to see you. As always, appreciate your thoughts. Jonathan Pingle there of UBS. I promised to revisit with Mike McKee. Mike, I know you're looking at that data. What explains it?
Boeing, one word, Boeing. Transportation equipment, non-defense aircraft up 139% in terms of orders. We also had some strength in automobiles. Motor vehicles were up by 2.3%. That's not as strong as last month's 1.5, but it's still fairly strong. And we did see some strength in other areas that you might expect some pull forward. Primary metals, fabricated metal products do come up. Interestingly, though, computers and computer equipment, they fall 2.9% orders there. So there were some areas in which people are already starting to cut back. This is maybe the first hard data we can say that starts to match up with what we have seen out there in the markets.
Interesting. Mike, keep us on top of things. Might be key there on the latest economic data. Let's turn back to the trade story. China and the latest there, demanding the US to revoke all unilateral tariffs and denying any talks on a trade deal. Joining us now to discuss is a veteran economist, financial regulator, Jose Vinaz, the chairman of Standard Chartered. Jose, it's good to see you, sir.
You too. Good morning.
You've quite literally seen it all in your time at Standard Chartered, the IMF, and the Bank of Spain once upon a time as well. Have you ever seen it like this before?
Well, I think that the uncertainty we're having is very high, but this may not be unique. I remember times, for example, during the global financial crisis, precisely at the beginning, at a month, September, October, here in Washington also, at the meetings at the time, the uncertainty was off the charts again. And we also saw a very difficult situation with COVID. So it is a complicated moment, but I think the world has gone through other complications and survived.
This is a policy shock, for sure.
Yes.
Do you see it morphing into a financial shock?
Well, I think that so far what we have is an impact coming from the tariffs, both in terms of the tariffs that are perhaps will be imposed, perhaps not. It will depend on the negotiations. But I think that what is unsettling is the fact that there is unpredictability regarding tariffs. And this is something which, as we know, is a deterrent to decision-making. So far what we're seeing are the economic consequences in terms of the postponement of decisions by households and also by businesses. And this complicated environment may be resolved for the better or for the worse. But so far, I don't think we have seen significant financial consequences beyond the stock market volatility that we have seen over the past few weeks, and also some interesting gyrations in the U.S. Treasuries market.
Which we'll get to in a second in terms of just how much that does affect stability. I am wondering, we are seeing, though, a pretty seismic shift in rhetoric in terms of what the ultimate goal is for the trade partnerships between the world's biggest economies. And for Standard Chartered, where 90% of all profits come from Africa, Asia, and the Middle East, how much are you seeing your clients materially shifting away from the U.S. at a time where there is heightened uncertainty and real questions about, say, that Treasury volatility?
Well, our clients are trying to, first of all, to figure out what's going on. And I think that one of the most important things that a bank like us can do at this time is to stay very close to the client and help the client make sense of what is happening to the extent that this is possible, and then help sort of advise them on what are the potential options that they have depending on how this ends up. What we see in our clients through our markets is that they want to continue doing business with the United States. The United States is the largest economy in the world. The United States accounts for nearly 15% of global trade. The United States will remain a major force in growth and trade. So our clients want to continue doing business with the United States, but they also, I think, are thinking about diversifying more. And all of these will end up depending, this diversification, on what is the ultimate outcome that countries are having in their bilateral negotiations with the United States. But I can tell you that if at the end of the day, what we have is that there is a lot more friction in the trade between the United States and the rest of the world is going to increase further the economic and financial relationships that they have. And we have already been seeing this for quite some time, that if you look at the dynamics of global trade over the past 5 to 10 years, you have seen that the dynamism of trade among emerging markets far outweighs the dynamism of trade, with advanced economies.
So this actually raises the question that we've been talking about all morning. How much do some of the U.S.'s trade policies push the likes of Europe closer to China, as well as the rest of the developing world?
Well, I think that it's very natural that if you're doing less business or potentially doing less business with a particular partner, which may be very important, as the U.S. will continue to be, you may try to do more business to sell your products in other markets. And what we have seen in these few weeks is that a number of areas in the world are thinking about furthering their integration. For example, I was in Malaysia a few weeks ago. They were having the ASEAN +3 official meetings with ministers of finance and central governors. Well, the ASEAN region will pursue closer economic integration because there are more gains from trade that they can achieve by being more closely integrated. Asia has other regional trade arrangements which are going to be more important in terms of further integration of the different Asian sub-regions. And you have an increasing connectivity already between Asia and the Middle East. That is something which is very interesting. This is growing very, very significantly, of course, between Asia and Africa. It used to be China and Africa mainly, but now you see, for example, the Middle East also playing a very important role in terms of the connectivity with Africa. So the trade corridors are reshaping, and Standard Chartered is very fortunate to be sitting on markets which, are some of the most dynamic markets in the world. And we will see this further connectivity, and as a bridge bank, as a formidable super connector, we're going to be there to provide this further connectivity within emerging markets, but also do whatever we can to continue the connectivity with the United States.
What it sounds like from you, though, is that these trading partners, if the U.S. goes out and says, I want you to help us confront China, they're unwilling to do it at the behest of the United States.
Well, I'm not going to prejudge what the outcomes of negotiations are going to be because all of this is very complicated. But one thing I want to tell you is that there are many countries in the world which want to be on good terms and do a lot of business with the United States and with China and with Europe and with the UK and with Canada, so you don't want to choose. So the question is how you manage that. And there may be some trade-offs that you need to make. But again, I think it is in the interest of the world, first, that the global imbalances that we have could be reduced insofar as some of them may be unsustainable. That's something, for example, that the IMF has been looking for many years at these global imbalances, many, many years. So some of those imbalances, it could be healthy to address them, but on the basis of things which would be good for the national economies behind it, because at the end of the day, the external imbalances reflect the internal imbalances. And I think that all countries need to play a role in making that happen. So you need to have fair trade with lesser imbalances. And I think that trade is indispensable for the growth of the world. It's like blood to the body. We need to make sure that we preserve fair, but reasonably open trade circuits so that the world can be moving forward.
You've articulated that argument quite strongly. It is not surprising to me or anybody else that a multinational wants access to multiple nations. The issue that we've got at the moment is that they might be forced to choose. And this isn't really new. I think China has made a point repeatedly that certain companies aren't welcome in their country. And then maybe the United States will take a page out of their book and do the same thing to other companies looking to come into the United States. And I just wonder, Jose, whether in 5 years' time, whether you really think we'll be in a position where they do have the ability to choose, whether that choice won't be forced on them, a choice between the United States or China.
Well, I think that there is the United States, there is China, there is India, there is the ASEAN region, there are the Gulf Cooperation countries, there is Europe, European Union and the UK, there is Africa. There are many different parts of the world. And even if there may be some constraints, which, by the way, already exist, because we have sanctions, we have export controls,
of course,
we have limitations to cross-border trade and investment flows on the basis of national security. Even if some of those may get a little bit larger, I think that it is ultimately in the interest of all countries, including the United States and China, to have an environment which of course takes care of their concerns, but allows U.S. firms to continue doing important business in China and China-related sort of countries, and for Chinese firms to continue doing business in places which are in the United States sphere of influence. So I think that this should be the target. And listening, for example, yesterday to the U.S. Secretary of the Treasury talk about the possibility of a big deal between the United States and China, that is in a scenario that I think would be very important for the world. And the fact that this is mentioned by the United States, I think it's important. And I do hope that we sort of bring the souffle down in terms of these tensions, because the world economy and the people in the world cannot afford a continued sort of confrontation at this level in terms of a trade war between the two largest economies in the world.
We've certainly taken the temperature down this week, but as things are still very hot, as you know. Jose, it's good to see you, sir. Thanks for being with us to share your perspective. Thank you. Jose Vanals there, the Standard Chartered chair. Up next on the programme, we'll run you through the week ahead in just a moment. For now, though, let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahira Hackett. So, Yahira.
Hi, John. President Trump pushed back against imposing a higher tax rate on millionaires, saying it would cause them to leave the country. The remarks could discourage further talks about creating a new 40% tax bracket for people earning $1 million or more. Lawmakers return to Washington next week, where you are, to begin discussions on a tax package. Meanwhile, Whirlpool shares are rising 2.5% in the pre-market. The company maintained its full-year financial outlook, saying the long-term impact of global tariffs will benefit its position in the U.S. home appliance market. Whirlpool saying tariffs will, quote, level the playing field by raising prices for foreign manufacturers. And Japan's major car makers, including Toyota, Honda, and Nissan, saw a surge in U.S. sales last month, with Americans rushing to buy cars before Trump's tariffs on imported vehicles kicked in. Toyota sales rose 8% from a year earlier. Nissan sales rose 10%, and Honda recorded a 13% jump. That's your Bloomberg Brief. John?
Yahira, thank you. Appreciate it. Thanks for this morning. Up next on the programme, we'll set you up for the day ahead as we look forward to a busy close to the week in Washington. From Washington, this is Bloomberg.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
What's the hardest part of being a CFO?
It's hard to come up with that.
It's the vast responsibilities, the need to be engaged in different topics.
It's remembering which audience I'm speaking to and what I can say in that context.
The job is not just being the executive of the finance function, it's being an executive for the company.
I would say it's prioritization.
Complete the sentence. The hardest part of being the CFO is
telling people no. It's hard. It's the right thing to do, but it's always hard.
So being just like a touch of a heartbreaker, basically.
Yeah.
We have a plethora of good opportunities. Some are really, really good. But as we strive for the great ones, sometimes those really, really good ones have to be left behind.
New episodes this spring, only on Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Earnings season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
The opening about 37 minutes away, and equities just about turning positive in the last couple of minutes or so. That's your price action right there, positive by 0.2% now on the Nasdaq 100. Let's get you a preview, a sneak peek of what to look forward to through the rest of the week. Here's your trading diary. Today, President Trump meeting with the Prime Minister of Norway. Then later on, we'll get earnings from Alphabet after the closing bell. Look out for that. Going into the weekend, UMich consumer sentiment, and looking ahead to next week, on Tuesday, JOLTS data and consumer confidence. On Wednesday, more earnings from big tech, including Meta and Microsoft, and slowly getting closer to a very important payrolls report not too far away.
Yeah, maybe the first where we start to see some of the ramifications from the lack of certainty that we keep hearing about. The earnings have been notable in terms of people withdrawing guidance and getting a sense that that uncertainty is starting to put on hold a lot of their plans for spending.
I'm looking for potential clarity, though, this week. Kevin Hassett said yesterday there's more than countries bringing in more than 18 blueprints to try to strike a deal. He said Ambassador Greer's in 14 some odd meetings. They're all in meetings this week on the sidelines of the IMF. And they say they want to get these blueprints out before the 90 days. So maybe we will have some certainty of who's getting deals and what concessions the U.S. wants to get to those agreements.
As finance ministers from around the biggest retailers in this country, Home Depot, Walmart, and Target, telling the president, reportedly, the prices are about to go up and the shelves are about to empty. Your coverage continues tomorrow, live from Washington, D.C. We'll catch up with Nathan Sheets of Citi. We'll speak to Wally Adeyemo, the former U.S. Deputy Treasury Secretary, the IIF President, Tim Adams, and the NASDAQ CEO, Adena Friedman. Looking forward to being with you tomorrow in the nation's capital. Equity futures right now on the S&P just about unchanged. Your opening bell 35 minutes away. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.
Welcome back to another special Mutua Madrid Open update for Bloomberg TV and radio from Tennis Channel. Former US Open champion Emma Raducanu clinched her first outdoor clay court win since 2022 with a hard-fought victory over the in-form Suzanne Lamons. The Brit fought back from a breakdown in both sets before closing out the win 6-4 in just under 2 hours. And don't forget, you can watch all the action live daily on Tennis Channel.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly.
There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything.
DraftKings hit a milestone in the second quarter of 2024. For the first time as a public company, it turns a profit.
Is this a new era for DraftKings?
There's an inflection from when you're cash flow negative and you're operating off of equity raises from the past to when you're self-funded and you're cash flow positive and able to control your destiny a lot more.
You've had your first quarters of profitability now. Does that take pressure off? Does it increase pressure?
I think it increases pressure. I mean, once you start making profits, people expect you to make more, and all of a sudden you're valued on a multiple of those profits as opposed to the theoretical what could be. So very important, I think.
When you're cash flow negative, you've sold a vision of what the company should be working on, and you're very focused on working on that and delivering against that. When you've pivoted to profitability, the world of what you can work on is a little bit open, and there's a lot of different ideas, and it requires more focus than ever to make sure that you are prioritizing on the most important things that are going to deliver the most value.
DraftKings' solid standing in a booming sector gives them the luxury to play the long game. They're not under pressure to cut costs.
When you have really strong revenue growth, you don't need that. If you look at where we are today and where we want to be and where we believe we will be, the vast majority of the incremental EBITDA is not coming from any cost reduction. It's coming from increased revenue.
We don't feel like we need to cut costs because we're growing our revenue so much. We want to grow our revenue into our existing cost structure, and there's no need to reduce the cost as long as we're being efficient with what we allow our cost growth to look like.
All right, let's cut right to it. This is Bloomberg's new show, Primer. Technology is $1 trillion game. Won, lost, won again, just by backing the right science at precisely the right moment.
My life has been focused on how can you elicit intelligence from brain cells in a dish.
This is the fundamental building block of our fusion technology.
We're doing things that have never been done by anybody, ever.
Everyone is selling the future. If you want to understand what's coming, you'll want to watch Primer, because details matter.
Lasers on.
So do lasers.
There we go.
Oh, and it's on all these lovely channels. Hope you're jotting this down.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Jennifer Zabasaja in Cape Town, South Africa, and this is Bloomberg.
China rebuffs Trump 30 minutes until the start of trading. I'm Matt Miller.
And I'm Katie Greifeld. Sonali Basak is off today, and Bloomberg Open Interest starts right now.
Coming up, stocks back in the red as China denies tariff talks with the U.S. But some relief for autos. U.S. officials consider easing tariffs targeting car makers, and earnings season is in full swing with a spotlight on the consumer.
And speaking of earnings, the word uncertainty is dominating calls this quarter, with Chipotle and PepsiCo cutting their outlooks, while you have American Air pulling their 2025 guidance entirely. You can see stocks all moving a little bit lower pre-market. Matt Miller.
IBM also says uncertainty could force clients to pause work with the firm. ServiceNow emerging as a winner despite economic volatility, and we await Alphabet earnings tonight.
And on the trade front, Beijing is not budging when it comes to President Trump's softer tone on trade. China denying that the two countries are even talking, with the Ministry of Commerce saying, quote, the U.S. should respond to rational voices in the international community and within its own borders, and thoroughly remove all unilateral tariffs imposed on China if it really wants to solve the problem. Bloomberg's Tyler Kendall has the latest from the White House. And Tyler, just tell us where we stand right now, because obviously there's been a ton of mixed messages when it comes from the administration, and now China saying they're not even talking.
Yeah, hey, Katie, a lot of mixed messages, particularly from this White House, and that new reporting this morning that Beijing is now asking the U.S. to remove all unilateral tariffs, something that the Treasury Secretary told reporters yesterday. It's just really not on the table at this point. And then China's Commerce Ministry saying that those talks actually aren't happening at all, and any recent reports about developments actually are groundless. That comes after just yesterday in the Oval Office, President Trump, when asked if he is actively involved in negotiations with China, he said, quote, everything is active, then went on to reiterate he thinks that the 145% levy on Chinese imports is very high and amounts to a trade embargo, and that ultimately that number could come down. But at the same time saying that if a deal with Beijing isn't reached, that would be okay because the U.S. will set what he called a, quote, fair price. He went on to suggest that this White House might release revised tariff rates for countries, including China, in the next 2 to 3 weeks. And when we are talking about those other countries, we know, for example, Japan has been prioritized in these talks. New reporting from Bloomberg News this morning indicates that Japan will push back on the U.S. if it asks them to curb their own trade with China. To be clear, Japanese officials tell Bloomberg News that that ask has not been made yet, but we do know it's something that this White House is mulling.
All right, Tyler, thanks very much. Bloomberg's Tyler Kendall there, reporting live from the White House. The Trump administration also weighing changes to auto tariffs, more changes in a potential relief to car makers. You can see that General Motors and Stellantis shares are up in the pre-market. The White House may eliminate the so-called stacking of levies on cars and certain parts. Executives have warned the White House that current levels would deal a severe blow to profits and jobs. Bloomberg's David Welsh joins us now. And David, can you explain these incredibly complicated, always changing tariff rules on autos?
Sure. Good morning, Matt. There's a lot of things being kicked around, but what we're hearing is they might get rid of two things. One would be this stacking of tariffs, which is basically tariffs not only on the parts, but the steel as well. And then there's another part of this proposal, which is they would cut the tariffs on USMCA compliant parts. So what they'd already talked about putting in place is you have a tariff on the vehicles coming in from Mexico, for example. If they are USMCA compliant, that is, they have enough parts content, they can still get off the border with a much lower tariff, actually no tariff, but we would still place tariffs on the non-U.S. content in those vehicles. They may also get rid of that, which that would be a big boon for the Detroit Three because General Motors and Stellantis specifically make a lot of vehicles in Mexico, and they also have a lot of Mexican parts content on those coming up. And that would, even if they just lowered that from 25 to say 10% or something like that, that would relieve a lot of the burden on, say, Chevy and Ram pickup trucks coming over the border. It's all fluid right now. We don't know, but it does look like the administration is at least considering some proposals that would reduce the tariff burden on vehicles coming in from Mexico and Canada.
Fluid is a good way to describe this situation. We appreciate you staying on top of it. That is Bloomberg's David Welch joining us from Detroit. Meanwhile, on the earnings front, Procter & Gamble cut its annual sales and profit outlook. You also have Pepsi cutting its full-year guidance, but Keurig Dr. Pepper reaffirmed its 2025 guidance for steady growth. Let's discuss all of it now with Barclays analyst Lauren Lieberman. And I want to start with the big guys. Pepsi and Procter & Gamble lowering their guidance. Does that imply that there could be higher prices in the offing as they try to protect their margins?
So I would say both companies are not going to rely on pricing as the way to solve this. In fact, if anything, what's been challenging is that the consumer's under pressure. And so what you're seeing is consumption slow down and raising prices. We know elasticity happens, and that could only put things under further pressure. I think where we may see pricing later in the year would be in response to tariffs. One thing that P&G just talked about on their conference call is they expect to see an annualized impact of $1 to $1.5 billion on their cost structure from tariffs, and pricing will have to be part of the mitigation plans to deal with that.
Lauren, what are the biggest inputs that are manufactured overseas that these companies have to import? And is it likely, yesterday we talked with somebody who runs a frozen yogurt company, he said paper packaging is what he needs the most. Is it likely that those things end up being produced in America?
So all of our companies have been, frankly, fairly vague about what it is that they're importing. Kimberly-Clark reported yesterday they also had a bigger than expected impact from tariffs because of imports of finished goods from China. So we don't know a lot, frankly. Raw and commodities and packaging is certainly part of it, but there's also an impact in a piece of finished goods imports that happen from China. As for whether or not we get a shift to the U.S., frankly, I think companies are going to be more likely to look at alternative sources of supply outside the U.S. than committing significant amounts of capital to U.S. production when there isn't visibility in terms of longevity of policy change.
That's the thing. And also, it was interesting to hear the Whirlpool CEO say on their earnings call this morning that 20% tariffs will not move factories from China. I know that's not exactly in your wheelhouse, Lauren, but I want to go back to pricing and what you were saying, that we could see some of these companies take pricing actions maybe in the second half of the year in response to tariffs. Some interesting moves from Unilever and Nestle over in Europe, basically posting better than expected sales because they raised prices. I hear what you're saying, that the consumer is stretched here, though. And if we were to see some pricing actions from these companies, how sticky are those increases?
So pricing's been incredibly sticky. I mean, we had massive pricing, as you well know, right, across the last couple of years in some of these categories. I mean, Frito-Lay at Pepsi They took pricing up, mid-20s to 30% over a several-year period, and volumes held in flat for a long time and then have been declining for the last 12 plus months. So the room that there is to take more pricing, frankly, it feels very limited. KDP, I know we're trying to stick with the big guys in the conversation, but KDP, I mean, at-home coffee is a cost savings versus away-from-home coffee. However, when you have to buy in a multi-serve format, so you buy a box of multiple pods of coffee, it's a higher dollar outlay at the store, right? So they're talking about so-called price pack architecture. How do we bring down that dollar outlay at the store in order to increase frequency of purchase? So the companies, it's challenging. I mean, P&G talked about the massive amounts of innovation coming to market, and they will price with that innovation. That's the best case scenario, when you can price with news, not just price on what exists on the shelf.
It is a shock when you're at Costco buying a box of those pods and they're like $40. Let me ask about any benefits, not to harp on Whirlpool too much, but they have said that tariffs will benefit them in that these low-cost producers from Asia won't be competing in the market at a price point that beats them. Is that the case for any of the companies you covered? Does P&G or Keurig Dr. Pepper benefit at all from tariffs, protectionist tariffs, holding competition out or holding prices up?
I mean, I think the only category I can quickly jump to is diapers, and this is getting very specific. But there has been a significant uptick in imports from China into the U.S. diaper market under kind of cute new branding, some exclusive brands at Walmart and at Target, and those other brands have been taking share. So that's one spot I could point to. At the same time, both Procter and Kimberly have significant quality upgrades that they've already been planning to make and been working on for some time in the Pampers and Huggies brands. But that's one category I could highlight pretty specifically.
All right. Great to have you on the show. Hope we can get you in the studio soon. Barclays analyst Lauren Lieberman there talking to us about some of the effects of tariffs on these companies and earnings from Procter & Gamble and Keurig Dr. Pepper. Some more movers on our radar today. Texas Instruments gives a robust forecast on demand rebound. You can see those shares are up 10% in the pre-market. Merck expects to lose $200 million to already announced tariffs in 2025, but says it also has a better outlook now, or at least is holding the outlook stable. You can see the shares up 1% in the pre-market, and Bristol Myers boosts its outlook as older drugs drive sales, a sales beat, but those shares are down 1.2%.
Yeah, there you have it. A lot of interesting moves. You take it into the broader market, though. I will say the S&P 500 pretty much unchanged in the pre-market right now, Matt Miller, which is interesting because we were down somewhat significantly just a couple hours ago.
Yeah, absolutely. I mean, it's a changing market, right? But I was looking at futures today and saying, I don't know if it's a futures down day as much as it's a halt the rally day, right? We're not rising as much as we were. You can see S&P futures right now up, but only 0.04%. NASDAQ futures up 0.2%.
All right, later this hour, I'm pleased to say we're going to be speaking to one of those companies. We're going to speak to ServiceNow CEO Bill McDermott. Stay tuned for that.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything. Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
What's the hardest part of being a CFO?
It's hard to come up with that.
It's the vast responsibilities, the need to be engaged in different topics.
It's remembering which audience I'm speaking to and what I can say in that context.
The job is not just being the executive of the finance function. It's being an executive for the company.
I would say it's prioritization.
Complete the sentence. The hardest part of being the CFO is?
Telling people no. It's hard. It's the right thing to do, but it's always hard.
So being just like a touch of a heartbreaker, basically.
Yeah.
We have a plethora of good opportunities. Some are really, really good. But as we strive for the great ones, sometimes those really, really good ones have to be left behind.
New episodes this spring, only on Bloomberg. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
All right, one of the stocks we're watching today is IBM out of Armonk, New York. The stock is down 7% in the pre-market after missing expectations for sales. First quarter sales rose, but only 1%, suggesting economic uncertainty, which they called out, and U.S. government cost cuts may dent the company's business. Joining us now is Mandeep Singh of Bloomberg Intelligence. So before we get to the big one, let's talk about Google coming, and I know Katie's anxious to get to that. But let's talk quickly about IBM. They were one of the many companies that called out uncertainty this morning, Texas Instruments, another one. How's it going for IBM?
Well, when you look at all the companies that have reported so far, including IBM, like consulting feels like discretionary, and this is the type of environment where things may not get better on the margin. If you look through the rest of the year, everyone is so uncertain that, estimates are probably gonna come down or be sideways. And from that perspective, low growth is never exciting. They have acquired a company, HashiCorp, and then there's another acquisition they have done, DataStax. So all that growth is inorganic. But on the margin, numbers are coming down and no one seems to be excited right now.
What I heard there was consultants are discretionary, which seems like a pretty big call, but let's move on. Let's talk about the big one.
Don't need them.
Don't need them, not in a recession. Alphabet, reporting after the bell today. The narrative here is that it's really going to set the tone for the rest of the tech earnings. I know that we've gotten Tesla and Netflix so far. They feel a little bit idiosyncratic. There's a really interesting quote in our write-up, this coming from an advisor over at Clearstead Advisors, saying that basically the devastation in big tech stocks such as Alphabet has been so severe, there's actually some room for error here.
I don't know, because when I look at their core business, digital ads, it feels like they're exposed to discretionary spending as well. Autos, retail, consumer discretionary. All these companies have nowhere else to go but to, still advertise on Google Ads. But there are Chinese advertisers, Temu, Shein. If they're barred from doing business here, why would they be spending on ads? And that's where, if you're an online company, there's no other place to go but on like Google and Meta. So you're not gonna just take away all your spending, but on the margin, still things will decelerate. And that's where, because ads is such a high margin business, even if cloud does phenomenally well, YouTube does great, it's not going to make up for their profitability. And look, they have announced an acquisition of Wiz, $33 billion. So when you look at the overall free cash flow for the year, they're spending $75 billion in CapEx for AI data centers. They're buying this company. How can they grow free cash flow when, the top line isn't really accelerating?
Okay, so Matt, things can get worse.
Things can get worse, but I'm wondering if there's any benefit to these companies from Trump's trade war or tough talk. I noticed yesterday the EU took Google for $500 million and $200 million from Meta, and everyone's like, whew, thank goodness it was only that much.
Yeah, no, maybe regulatory stuff takes a backseat, although we don't know what will happen to the Chrome decision, you know, the divestiture that in the monopoly case, so that's an overhang. But look, these companies have got almost 55 to 60% international revenue. Tariffs will be a negative for any U.S. company that has got international revenue. So from that perspective, all of your Mag 7 are exposed, negatively exposed to tariff, I would argue, because internationally, I don't think tariffs are going to help you much. And I think in the case of Alphabet, clearly, you know, international revenue is there both from the advertisers as well as the revenue they generate outside the U.S.
All right, Mandeep, great preview of what to expect a little bit after the bell today. That is Mandeep Singh of Bloomberg Intelligence. Alphabet shares, for those keeping track, down 18% year to date. Now we have some other earnings movers on our radars. Let's talk about American Airlines withdrawing its full year earnings outlook. The shares a little bit resilient here, though, but you can see only down about 0.4%. Chipotle also cut its 2025 outlook after quarterly sales declined, and ServiceNow results guidance showing economic resilience. You can see shares up 9.5%. The market overall, though, the S&P 500 pretty much unchanged. A little bit of quietness after a rip-roaring couple of 2 days. We'll discuss all of that action next and start the trading day with Emily Rowland. This is Open Interest.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Well, we saw more concerning commentary from Wall Street strategists this morning. Deutsche Bank's Binky Chadha, one of the biggest bulls on U.S. stocks, he cut his year-end target on the S&P 500 to 6,150 from 7,000. Still significantly higher than current levels, but it's the direction of travel that is concerning here. Meanwhile, you also had Christopher Wood over at Jefferies believing that the U.S. stock market has reached its peak. Let's discuss all of that with Manulife John Hancock, co-chief investment strategist Emily Rowland joining us now. So Emily, let's talk about U.S. exceptionalism. There's a lot of passionate views on both ends here. Some saying that, yes, we've peaked, basically. We're in the rearview mirror when it comes to the U.S. dominating these financial markets. Others saying that those fears are way overblown. Where do you fall on that debate?
Yeah, certainly markets and sentiment surveys are telling you that. You look, for example, at the Bank of America Fund Manager Survey, which says that sentiment on U.S. assets is the lowest in about 30 years. Meanwhile, you look at the fundamental and the economic data, and the U.S. is still doing better on a relative basis. Just looking at 2025 earnings growth estimates, we're still around 11% in the U.S., and every day, EFA and Europe indices continue to move lower, where the analysts are now looking for about 4% earnings growth in Europe. Meanwhile, economic data are still coming in modestly better in the U.S. We look at things like PMIs as really timely reads on the health of an underlying economy, and the composite PMI in the U.S. is outpacing Europe and, in fact, beat expectations over the course of the past week. So the economic and earnings trends are favoring the U.S., while the sentiment trends, the capital flows are massively favoring Europe right now. We would probably fade that and focus more on earnings and economic trends.
Are you expecting, when I hear people say we're waiting still for retailers to post earnings, I think immediately of the pull forward in demand. Are you expecting us to see a lot of that this earnings season?
Yes, we are, and it is feeling backward looking, and we think, you look at things like durable goods orders this morning just absolutely accelerating, and really that was likely based on a pull forward in demand. Same thing when we looked at retail sales data last week. So I think everybody's sort of throwing out the backward looking data and looking for guidance from many of these companies. And there's just been such a wide band. Even some companies just not offering forward guidance given the political uncertainty surrounding tariffs. So we'll be watching for whatever type of forward guidance we can get from those retailers. But for now, things look pretty solid.
I'm glad you brought up durable goods because that was a doozy coming in. Preliminary numbers for March at 9.2% increase there. The survey had been for 2%, so clearly a pull forward, like you say. I want to wrap politics into all of this because we talked about that Binky Chadha call, that lowering of expectations. He did say that basically to get to these levels, a credible relent likely needs a significant decline in approval ratings. After the initial honeymoon period, approval ratings tend to align with what is happening in the economy. And Emily, I'm curious to get your thoughts there because we've seen so much back and forth when it comes to the trade policies of this administration. When do we start to see some stability? Does it come from approval ratings?
Yeah, it does feel like we sort of maybe got to peak political uncertainty, and there's a little bit of relief on that front, given the fact that it appears that negotiations may start to play out here. We try to minimize using politics and making investment decisions. I know that seems almost ridiculous right now, given how much of an influence politics are having, but we were, looking back at the decisions that we made in 17 and 18, and we did look at overweighting international equities at the time. There was a lot of excitement and positive sentiment about the pro-cyclical, pro-business policies that the Trump administration had planned to implement, and that outperformance did occur, but it only lasted for a couple of quarters. We look longer term from that, and again, going back to earnings, going back to fundamental trends, we still have a preference for U.S. stocks.
All right, Emily, we're just getting started here. That is Emily Rowland. She is staying with us through the open, and it looks pretty quiet right now, Matt.
It looks pretty quiet right now, but we know how volatile these markets are, and we know that anything can change on one tweet or one truth, right? President Trump out this morning tweeting about how he's brought down the price of eggs, brought down the price of fuel, a couple of debatable issues there. In terms of futures, we do see green arrows. More with Emily Rowland on the other side of this break.
we're micro investors. So as micro investors looking to invest capital, whether it's in private equity or in direct lending, what we're looking for are opportunities to deploy capital at attractive risk return. When we wake up in the morning, we don't seek to avoid risk. We seek to price it correctly. And so in an environment like this, for sure, if you're looking at a portfolio company opportunity, when you think of the value creation plan, you're factoring in now the uncertainty, which undoubtedly will impact the extent to which you're willing to pay for that asset. Now, in our existing companies, in our existing portfolio, the vast majority are services company. And services companies don't have basically the input issues. But I will say that when we look and we roll up all this data for all of our portfolio companies, and it's quite rich, it's just down now below 1 million employees globally around the world. We're 2,300 at Carlyle itself, but in our portfolio companies, we roll up this data every month. For example, the inventory component of PMI was up about 4 points. I know that's not really news that anybody probably would have focused on, but we could see that happening months ago. So immediately when it looked like the new administration was going to come in and there was the possibility of tariffs, you could see purchasing managers immediately mobilizing to start bringing goods in faster because of the uncertainty factor.
US tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Moments away from the start of trading, this is Bloomberg Open Interest. I'm Matt Miller. We are seeing futures now pointed up across the board, even after China came out, rebuffed Trump's statement that they were in talks and said the U.S. needs to lower tariffs completely before they will get into discussions. So we have 0.2% now on the S&P, almost double that on the NASDAQ. Investors more bullish going into this session than they were over the past couple of hours. Down at the New York Stock Exchange, we've got Volunteers of America ringing the opening bell, good for them. And down on the NASDAQ market site, here we have Pinnacle Foods ringing the opening bell, PFAI, the ticker there. But Katie,
yes,
the word that they may be thinking about, that they may be concerned about, is uncertainty. We've been hearing that across the board out of earnings.
It is the word of the season, truly. If I had a dime for how many times uncertainty had been said on earnings call, I would have at least 3, because you had Chipotle and PepsiCo pulling their outlooks this morning. American Air also pulling its 2025 guidance entirely. I'm getting closer and closer to $1. You take a look at what's happening to these stocks in the pre-market. You actually have, or rather the open, you can see that Chipotle higher a little bit, PepsiCo down a little bit, American Air a little bit higher. Just feels like everyone's tired, Matt.
Yeah, I will say Southwest called out uncertainty. Alaska Air called out uncertainty. America Air called out uncertainty. Pepsi, uncertainty. CMG, Chipotle, uncertainty. IBM, Texas Instruments, Masco, Sonic. I could go on and on and on. And across the board, executives have no idea what's going to happen. And that's not great for business. That's not great for earnings. Bloomberg's Alex Semenova has been following the S&P 500 earnings broadly for us. So how are things looking, Alex?
So the results themselves for this quarter are pretty solid. If you look at the numbers, 78% of firms surprised to the upside. That is the most since the second quarter of 2024. Year-over-year earnings growth is at 7.4%. It's slightly above preseason estimates, but slightly lower than the past 5 quarters. But as you mentioned, Matt, it's not about what was in the past, it's about the future. And a lot of companies just don't know how to quantify the impact of tariffs on their businesses at this point. And that is really spooking investors. Earnings revision breath, which is a measure of upgrades versus downgrades, is approaching downside extremes. Morgan Stanley said that it's at levels that they've never seen this before. And the language from companies, as you said, guys, across various industries, Alaska Air, Pepsi, Chipotle, IBM, volatility, uncertainty, just that's the name of the game right now.
Yeah, we've been talking about that earnings revisions breath figures for a while now, because it is pretty stunning to see them at recession levels. And it just feels like, and this is a point we've been making, that every data that isn't real time. Every data point feels stale at this point. So when you take a look at the sell-side strategist community that you cover so closely, we're talking about Deutsche Bank downgrading their expectations for the year end just this morning. I mean, how do investors and strategists plan around all of this uncertainty?
I mean, the reality is no one knows what's going to happen, and a lot of strategists just don't want to admit it. If you look at Bank of America, Civitas, the Romanian, there said that the S&P could end anywhere from 4,000 to 7,000 by the end of the year, just highlighting the range of outcomes. JP Morgan said the same thing. They said it's basically impossible to, figure out what direction stocks are going, and you could look at the fundamentals, but anything can be changed by a tweet at this point.
All right, Alex, thanks very much. Alex Semenova there from Bloomberg News talking to us about the earnings reports thus far. We're only about a third of the way into earnings season, so there's still a lot to go, and the big ones are yet to come, the scary ones, like the big Mag 7 and the retail names. We're back with Manulife, John Hancock, co-chief investment strategist, Emily Rowland. So, Emily, I mean, especially for automakers, right? Their tariffs are changing on a daily basis for makers of electronics, chips, smartphones. What are the executives to do? How do you handle this if you can't put CapEx, if you can't make hiring decisions, if you can't know how much your goods are going to cost on ships?
Yeah, it's a massive challenge, Matt, right now, and that's the reason that we're seeing companies pulling guidance. They just don't know. We're seeing companies announce two different sets of guidance based on how punitive tariffs are going to be to their business. So again, a lot of uncertainty, but what we have to watch is what's actually happening. And even though the sentiment surveys are just incredibly bearish right now, we have to look at the real-time data. That's the best we can do right now. And things like initial claims this morning coming in at 222,000. Continuing claims actually coming down a bit this morning, and high yield bond spreads, which has peaked at about 450 basis points, down under 400 basis points. So we are watching the hard data right now. It's telling us that the economy is slowly slowing, but still doing fine. And in that case, companies should be able to maintain their margins. They should be able to continue to, provide solid footing here for the labor market. And until we see those real-time measures of economic growth start to move lower, then we see us in a solid position.
Well, I'm curious to take this conversation cross-asset. You bring up high-yield bond spreads, for example. Are there any asset classes that you can pick right now and say, this is insulated? This maybe not quite tariff-proof, but this is where I want to be. I'm thinking about gold, for example, hitting 3,500. It feels like that is one of the only true havens in this market.
Yeah, I mean, gold has just been on an absolute tear to, which obviously isn't surprising. It tends to be a hedge against both inflation and geopolitical risk, but certainly it's run a lot here. And we want to look to where there's relative value. So I think what's really notable about this market is that the assets that have sold off the most are actually the highest quality ones. You look at tech, and of course we had a valuation issue coming into the year in U.S. mega cap tech, but tech is the poster child for quality. These are companies with great balance sheets, better earnings growth prospects, wider moats, and you've seen really the baby being thrown out with the bathwater to a large extent. And meanwhile, the relative winners have been things like European financials and German industrial companies. Those parts of the market are highly cyclical and tend to trade on a rebound in global economic growth. We don't think we're there right now. We think the global economy is slowing. If U.S. exceptionalism is at risk, global exceptionalism is at risk here. So we want to look to those higher quality assets that are on sale.
Well, you could make the case that a high quality asset on sale right now is placed at the long end of the Treasury curve. You had PIMCO, JP Morgan Asset Management coming out and saying that there's actually opportunities there after the sell-off we've seen, but we know that bonds have been a really unreliable hedge, Emily. Where do they fit into a portfolio right now if you're looking for safety?
Yeah, Katie, coming into the quarter, we actually increased our allocation to high quality bonds. We would look at any backup in rates as a gift to investors right now. And one of the narratives that I think investors might not be fully sniffing out is that we see disinflationary trends taking hold. I know that there may be a short-term inflationary impact of tariffs, but we look at things like the housing market, which drives inflation. And if you look at shelter CPI, that finally came down last month to 0.2%. Real-time measures of housing are suggesting more disinflation there. Mortgage rates are very prohibitive. They're back above 7% right now. You look at things like supply coming online. We're seeing some of the biggest jumps in housing supply that we've seen in quite some time. At the same time, the demand is stagnating due to unaffordability issues, higher insurance costs, et cetera. So if we can start to see housing continue to come down here, that brings inflation down and provides a counteracting force to the inflationary impact of tariffs here. So watch that dynamic playing out. That means bond yields move lower, and there's a lot of opportunity for total return potential within high quality bonds.
I wanted to bring up the inflation subject again as well. As I mentioned in the last block, Donald Trump put out a truth this morning. He says gas and grocery prices are way down, just like I said they would be. Eggs are plentiful and down 87%. Nice. If you look at the data, and I realize that some of this data is not fresh. For example, the white line here is the CPI food index, up, up, up. Okay, that ends in the end of March. We could see a drop there. The blue line is average national gasoline prices. Those are updated, if not daily, weekly, so that's not too backwards. It hasn't really come down that much thus far, Emily. So should the Fed be looking at a preemptive cut, or should they still be worried about inflation?
Yeah, the Fed's not going to act preemptively on the inflation front. They're going to be looking for confirmation in the real-time data, which may lead them to be behind the curve here. But I do want to comment on the commodity discussion there, because if you do expect a meaningful rise in inflation from here, that almost has to be accompanied by higher commodity prices. That is really a key driver. And we're seeing the opposite based on particularly demand out of China slowing, on decelerating global growth there. So if commodity prices can come down, if we can see housing inflation come down, that is something that's going to be a positive here for the bond market. Yes, rates are chopping around here, but I don't think that bonds are sniffing out the slower growth and disinflationary environment that we think unfolds over the course of 2025. Got to be maybe a little bit patient to get there.
Yeah, there's a really interesting disconnect brewing between, of course, survey expectations of inflations and what we're actually seeing in commodities. Unfortunately, we got to leave it there. Emily, great to speak with you as always. That is Manulife John Hancock's Emily Rowland. Now, coming up, ServiceNow results show strong demand for software. We'll hear from CEO Bill McDermott next. This is Open Interest.
Incidence of cancer, which is to say people getting it, is higher than it was 20 or 30 or 40 years ago. Is that because detection is better than it used to be?
All right, so the dirty secret is we have no idea. We don't collect data well in the United States. What we do know is that there's not a dramatic rise in cancer in the United States, but what we are seeing is a troubling trend is younger people are getting more cancers. That's real. We have no idea why, but we are seeing younger people, more colon cancer, more breast cancer, and other cancers in younger individuals, 20, 30, 40-year-olds, that we never used to see.
What do you think could possibly be the cause? I assume pollution or the environment in some ways?
We assume it's either something in the environment, we assume it's diet, it's ultra-processed foods, it's microplastics, it's changes in the microbiome. We really don't know.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region.
Join us as we get to the heart of African business, politics, and economics and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg. Bloomberg surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern. Only on Bloomberg. Context changes everything.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly.
There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything.
Welcome back to Open Interest. A check on stocks at session high with the S&P 500 higher by 0.4%. You can see that a lot of that strength is coming from big tech, with the NASDAQ 100 up about 0.8%. The little guys getting in on the action too, but we'll see how this picture changes as we get deeper into earnings season. Alphabet after the bell tonight, but it's time now for our top calls. Some of the analyst action in focus this morning, and first up, Oreo maker Mondelez is getting a downgrade from D.A. Davidson on soft snacking demand and cocoa volatility. Next up, you have Deutsche Bank upgrading Huntington Bank shares and M&T Bank. The firm is confident that bank stocks have bottomed and also sees upside in the large regionals versus the big banks. And finally, ServiceNow getting raised to a buy over at Present Capital Management. The software company reported first quarter results that beat expectations and gave a strong outlook. And Matt, shares currently up almost 14%.
Yeah, absolutely taking off. And we are going to talk with Bill McDermott, the CEO of ServiceNow, formerly of SAP, in just a moment. Those shares going the opposite direction of what we see happening with IBM. IBM is down after it missed expectations for sales. They did grow, but only 1%. Bloomberg Technology's Caroline Hyde joins us now in the studio to talk about the company out of Armonk. So IBM missing expectations. What's the problem with Big Blue?
They didn't actually miss expectations, Matt. They actually beat, if you look at sales. We were expecting flatline in sales of 0%, but they managed to eke out 1% growth. But I think where you're right is the fact that there were built-up expectations because the shares have risen so hard. These sorts of companies, software-exposed companies, have been outperformers in the tariff turbulence, ultimately, because they have little exposure more broadly. Yes, they get mainframes. Yes, of course, they build plenty of their own hardware when they're thinking about quantum, but they build it in the United States. Ultimately, you're seeing software still remaining resilient. Many questioned whether DOGE, whether the efficiency coming from the government would be something that impacted shares. But ultimately, it seems as though that's not coming out in this set of quarter for IBM nor for ServiceNow. But there is a sell-off in IBM because I think the shares rallied so hard before it.
Yeah, down, I think, 8% in the pre-market last time I checked. So big drop there. That looks nothing like what we see at ServiceNow, where Katie just showed us the shares up 14%. I think Bill McDermott is good. Let's check in with him.
Let's check in with him, Matt, because I'm pleased to welcome to the show the ServiceNow CEO, Bill McDermott, who joins us on the back of what is some stellar numbers. Your shares are rallying. We're seeing basically a beat on sales. We're up 19%. You're also, though, delivering strong guidance when many other companies are pulling their guidance, Bill. What gives you the confidence?
We have an amazing culture here, Caroline. Elite level execution defines ServiceNow, and our AI acceleration delivered another outstanding quarter. It actually quadrupled. So ServiceNow has really become the AI operating system for the enterprise. And we see the software industrial complex literally integrating onto ServiceNow as the standard from every corner of the office. Companies are looking to run efficiently, effectively, with a different margin profile for this economic time, and we were built for this moment.
You do talk about potential risks regarding geopolitical environment. What are those risks? How are you seeing them?
Well, I think if you look at it, why we're so well positioned for this moment is companies today, let's take the auto industry as an example. Tariffs are on the table and that industry is affected. So these companies have to think about the marketplace very, very differently. They have to reorient their supply chains in real time. And only AI can do that. And you say, well, why did I have to do that? There's 30,000 parts that go into manufacturing a single vehicle. They may not be able to pass on the $10,000 increase to the consumer. So companies like ServiceNow can get them to tier 2 and 3 suppliers, sign up new suppliers in real time, and position these companies to win. And this is true in every industry. It could be insurance, it could be pharma, it could be retail, manufacturing. It's all in the focus of ServiceNow to help these companies innovate.
Let's go from private companies to the public sector. And I know that you've won a federal contract, but many had a lot of anxiety about what DOGE meant for you. You said DOGE loves you, but why would DOGE love you at this moment?
Well, we're laser focused on modernizing government and elevating how it serves the American people in the U.S. And what's really interesting about DOGE, it has formed a standard that other governments around the world are following. So our public sector business was up 30% year on year. We had 6 new public sector logos, including 1 large U.S. federal agency. We have 11 federal deals greater than $1 million, and 2 of them were greater than $5 million. And this is net new software sales. So this is kind of a big moment because we are the only software platform I'm personally aware of that can take out billions in cost in government around the world. And certainly the United States is looking at that very closely, and we're excited.
I mean, have you spoken to Elon about the work that he's doing? How did you make sure that you were protected in this moment to be able to bring the transformation, bring the efficiency?
Well, you have to remember the agencies are run by amazing public servants and great leaders. And DOGE is doing the right thing. They obviously want to make good for the American people so the taxpayers get their benefits. Our platform is front and center in helping them do that. There's systems like COBOL systems in there in government entities since 1959. And then the 20th century architectures where all of these legacy systems were departmentally organized. And then there was maverick buying over decades of different administrations. We can come in there and consolidate all of these spends onto the ServiceNow platform and replace hundreds of systems. And who wouldn't want to do that?
You do that with, you say, an elite team. You started the conversation with that. I'm interested in a change in the team. A top sales leader, Paul Smith, moving on. Is there anything to be worried about there?
Not at all. I mean, the good news is Paul and I had an opportunity to build out the go-to-market together for nearly 5 years. So we have a great relationship. And we mentored Paul Smith, who, by the way, is a veteran of the United States Army, 82nd Airborne Division. So he's got the discipline of a great leader. And he's run big brands for other companies. And he's been with us for 4.5 years. And we actually had him in the global sales job last quarter. So I think we see in the numbers what he's capable of. And I have high hopes that that will continue to grow.
I want to ask you lastly about your culture and the people, because more of them are going to be moving to Florida, right? West Palm Beach. Is that going to become your headquarters, Bill?
What we're going to do is we're a California company. We started in San Diego. We have a big development center in San Diego. We have a big development center in Santa Clara. So California's home base, but we've expanded. We're growing. So we have a big commitment in New York City at the Hudson Yards. And soon we'll have a deal done, hopefully, in West Palm Beach, where we'll be able to have sort of the West, the Northeast, and the Southeast covered with big hubs. And our dream is to have a next-generation AI university in West Palm Beach, where we team up with the Cleveland Clinic, Steve Ross and his outstanding company down there in West Palm Beach, and really build coalitions with the business community. But our dream is to be the AI operating system for the enterprise. We're on the move. Only ServiceNow can go east and west and north and south. And these companies, So building out AI all over the United States and all over the world is something we're quite passionate about, Caroline, and we're on our way.
Well, many loving the AI, Gen AI momentum that continues. CEO Bill Dermott of ServiceNow, thanks so much for joining us. Back to you, Katie.
Thank you.
All right, our thanks to Caroline Hyde for bringing us that conversation. ServiceNow up 15%. That is your biggest percent gainer in the S&P 500 right now, which is nearing in on session highs. This would be a third straight day of gains if it holds. We'll bring you deeper into the market action next. This is Open Interest.
Bringing you up-to-the-minute tech news whenever and wherever it happens. I'm Ed Ludlow in Las Vegas, and this is Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
This is Bloomberg Open Interest. I'm Matt Miller. Quick check on what's going on in stocks. Looks like we're getting some momentum back here. S&P 500 now up another 0.5% after the big rally that we saw yesterday and the day before. So 3 days of gains. The NASDAQ up over 1%. You just saw Bill McDermott and ServiceNow rising 15%. You can see that investors are buying bonds, pushing the yield down on the 10-year and the 30. NVIDIA up 1.5%. That's better than a stick in the eye. IBM is down 6.5%, but it's not hugely represented on the S&P 500. Ford is up on news that we could see even fewer tariffs on auto parts. American Airlines down and Chipotle up, but both of them talking about uncertainty. And then Whirlpool off a little bit, but maybe it's not so bad for Whirlpool, Katie.
Yeah, it was interesting. We heard from their CEO yesterday on Bloomberg Television saying that maybe tariffs actually help them.
To your question about the tariffs, you highlighted already the most important thing is 80% of what we sell in the U.S. is produced in the U.S. I know very many companies talking about reshoring, onshoring. We never left. So as such, we are, no matter how you look at it, we're structurally a net winner of a tariff.
All right, interesting comments on leveling the playing field, sort of borrowing a line from the administration there. That was Whirlpool. Now, coming up in the next hour, a lot of great conversations, including with Fed Board Governor Chris Waller. This is Bloomberg.
what would it mean for India to host the Olympics?
Linda, I don't think it's my dream alone. I think it's a dream of 1.4 billion Indians to see the Olympics being held in India. I think once sport takes over, the transformation will be seen, not only in the lives of the youths, but in the economy of our country. India is one of the biggest centers for digital usage, and 1/3 of the viewership of the Olympic channel comes from India. So India as a sporting market is huge.
Countries which have hosted the Olympics have always grappled with the issue of infrastructure, for instance. Building it is one thing, maintaining it is another. How can India do it differently if it were to host the Olympics?
So I think we're talking about innovation and sustainability. And I think the same holds for holding the Olympics. What if you look at a sustainable model? What if you look at refurbishing old stadiums, reusing what we have? So I think the move has to be a sustainable move.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything. Earnings season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
A higher tariff scenario, that they're not saying, costs are going to be increasing that much more, that prices are going to be that much more in a linear fashion.
Right.
It looks like it's actually consistent with an expectation of disruptive effects, potentially lowering demand for their products.
Okay, this is too short. We've got to get you back on again, particularly to talk about the Boston Red Sox. From the Boston Fed, Jenny Tang with us, just wonderful on Small Business America. Green on the screen, the Dow up 33 points. Paul?
All right, Tom, thank you very much. Coming up, this is the Bloomberg Intelligence radio program. Alex Steele is out today. She'll be back tomorrow, but Isabel Lee sitting in for Alex. Isabel, thank you so much for joining us again.
I'm excited. It's going to be a great day, and I really want to talk about the Beige Book in a bit.
Okay, very good. We're going to start it off strong here in just in a moment. Fed Governor Chris Waller, he's going to be speaking with Bloomberg's Michael McKee. They're down in Washington, D.C. We're going to bring that to you in just a moment here. But looking at the markets, the S&P 500 up 40 points, the Dow up 43 points, and the NASDAQ up 217 points. That's 1.3%. So just as Tom and I have been here with you this morning, we've gone to futures being negative to mixed to now we've got a little bit of a lift here in the market. So we'll keep you up on that. The yields, 10-year Treasury, we're around 4.33%. So we'll keep an eye on that. And Bitcoin, it is lower there. So coming up right now, we're going to bring you Michael McKee, Bloomberg's Michael McKee's down in Washington, D.C. with Fed Governor Chris Waller. Let's take a listen to their conversation.
Well, thank you very much, and welcome to Bloomberg Television and Radio Worldwide. Chris Waller, thank you for taking the time to come in today.
Yeah, thanks, Mike. I appreciate having me on.
You gave a speech a short time ago in which you said tariffs are the elephant in the room. Elephant seems to have only gotten bigger. You told me you were in St. Louis yesterday for a Fed Listens event, which is supposed to be about your framework review, and all anybody wanted to talk about was tariffs?
Yeah, that's pretty much the talk of the town. It's kind of hard not to talk about the economy without having to address it.
Well, the Beige Book yesterday addressed it, used the word uncertainty 80 times in that. Companies talking about not growing, but possible layoffs, getting ready to do something to try to mitigate the effects of tariffs. Are you hearing the same things from companies that they're sort of stepping back and just sitting on the sidelines?
Yeah, and that's the general tone of every person I've talked to out in the private sector, is that they're just kind of frozen by
what's going to happen with tariffs. And so CapEx, everything has just come to a stop. It doesn't mean it won't happen later when there's a little more clarity, but it has actually just stopped. If the tariffs, the large tariffs had stayed on or come back on, then firms are trying to figure out how they're going to absorb some of that cost. And the minute they do that, they're looking at other ways to cut costs, and labor is obviously one way they do that. So it wouldn't surprise me that you might start seeing more layoffs, a tick up in the unemployment rate going forward if the big tariffs in particular come back on. The smaller tariff world of 10 to 12%, most of the firms I talk to, they figure out they can deal with it. They kind of often give me this kind of formula. Our suppliers will eat a third of it, we'll eat a third of it, and we'll pass a third of it on to consumers. So if you're talking about a 10 to 12% tariff, it's not a big price hit to the consumers if that's all they pass through.
But economics tells us that tariffs in general are not good. So even if we get the smaller tariffs, does that still leave business on the sidelines and growth prospects lower?
Well, it is a tax, and it's inevitable that there's a tax. But however, I've always tried to tell people that, given the fiscal situation we're in, we need to get some better control of the budget deficit, and that means some combination of taxes and spending. It's just an argument about what taxes do you want to have to raise. So nobody likes taxes. I don't like taxes. But if you're going to get any kind of get our fiscal situation under control, you're going to have some tax revenue, and there's no obvious reason why tariffs should be off the table per se.
We have some tariffs in place, even though the president goes back and forth about other tariffs, but he put some on in March. When do we start to see that in the hard data?
Well, by taking off the April 2nd tariffs, you postpone that decision till July. So we'll see some of the 10% tariffs and the auto tariffs. Some of that will start coming through particular sectors. But it's not likely to me that by July 1st, you're going to see really big impacts from it. You will see it, like I said, in CapEx and things like that have just been put off to the side. So you'll probably see some softening in the data, but you're probably not likely to see anything dramatic happen before we get a better decision from the administration what they're going to do with the big tariff package that they initially proposed on April 2nd.
Well, what will we see first, a big rise in inflation or a slowdown in growth, perhaps epitomized by the unemployment rate?
I think you could see both of them almost happen at the same time, just in the sense of, like I said, that firms have to make a decision right away to pass through. Now, a lot of firms told me they have price contracts, so they're protected for a little while until they have to renegotiate those price contracts. But they're all anticipating, particularly the bigger tariffs, they're all anticipating they're going to have to cut costs somewhere. And the easiest thing to do when firms have 65 to 70% of their costs is labor, to start shedding some labor. So you might see layoffs start to happen about the same time you start seeing prices going up. So I'm not so convinced that it's going to be one first and then the other. You can see them both happen roughly at the same time, or very close together.
I assume that we're not going to see any move from the Fed on May 7th, but when would you have enough data, you think, to be able to make a decision one way or another on whether you need to move rates?
Well, as I was saying, the president's put off any decision on the large tariff world that was proposed on April 2nd until July. So all you're going to see probably till July is whatever the existing tariffs are in place. And as I said, I don't think you're going to see enough happen in the real data in the next couple of months until you get past July. When you get to the second half of the year, I think we'll start having better ideas what's going to happen with the tariff world that the administration's considering. And by then, you'll start seeing more in the form of tariff price pass-through and also stuff on the real side. But there's not like you're not going to see anything on the real side because of all the uncertainty in terms of freezing decisions, spending decisions.
Well, let's put some parameters around your thinking. On the employment mandate side, what level of unemployment would bother you?
Well, it's more the speed at which it would start going up. I mean, if it just ticked up 1/10, ticked up 1/10, ticked up 1/10, kind of like what we saw last year, it would be concerning, but it wouldn't be a big problem. But if it starts going up 2/10, 3/10 a month, then that's going to happen because you're seeing layoffs starting to take off. And the labor market's in kind of a good spot. It's not like 2022 where you could reduce vacancies. Now, if labor demand pulls back, it's going to be in terms of bodies. So you'll see employment start to drop. So I'm more concerned about the speed at which the unemployment rate starts going up. And if there's a big reaction to big tariffs, it could go up very quickly.
4.5% is, I guess, the SOM rule trigger. Would that be a trigger for you?
You know, I gave a speech last September where I kind of discounted the SOM rule as a mechanical description of the data, and what it really is capturing is shocks that hit the economy. A big tariff regime being put back on in July and being put in place for the foreseeable future, that would be that kind of a big shock. So it's not so much the SOM rule as the fact that the SOM rule is really always picking up some big shock to the economy. And the big tariff regime, as it was on April 2nd, would end up being a big shock to the economy.
Well, on the inflation mandate side, since you expect some inflation from tariffs, is it the speed with which it rises as well? Because we've seen a lot of volatility in inflation numbers recently.
Yeah, that's been the struggle for me for the last basically 18 months, is that inflation progress to our 2% goal has been this kind of seesaw. You're making progress going down, but then you get a couple of bad months, then it comes back down, and it's just slower than I ever thought it would have been, say, in December of 23. But the tariffs are a one-time. I still strongly believe, just economics tells me that the tariffs are a one-time price level effect that's going to pass through. Now, it's one-time level doesn't mean it's small or big. It's just a one-time. So I still think even if it was fairly large, you would see a one-time price level effect. The demand slowdown would offset some of that as consumers back off, employment goes down, unemployment rises, wealth continues, financial wealth declines. You will see demand effects from that that'll put downward pressure on inflation. So it may not be as high as people think. But the critical thing is it's going to be take some courage to stare down these tariff increases in prices with the belief that they are transitory. I'm not going to lie that we all have 2021 in our minds when we think about how we go forward. But, you know, the question is, what are the things that will cause this inflation to persist through the initial tariff increases? And I just have a hard time seeing exactly what that would be.
Well, do you think if we start to see the economy slow, that you would be more reluctant to cut rates because you expect that tariffs and the higher inflation will come down because of the demand effect?
See, I'm willing to look through whatever tariff price effects there are, and I've said that. So for me then, I'm not going to overreact to any increase in inflation that I think is attributable to the tariffs. But if I see a significant drop in the labor market, then the employment side of the mandate, I think, is important, and we step in, and we would have to start. I said this last week in my speech, you know, I would expect more rate cuts and sooner once I start seeing some serious deterioration in the labor market.
Now, some people looked at your speech last week and said, Chris Waller's on the opposite side of all this from Chair Powell. Do you think there's division on the Open Market Committee about what should be done?
Well, that's the beauty of not having groupthink. People have different views about how the economy is evolving and how policies should be done. I think that's actually a healthy thing. As far as I've heard exactly that comment that Waller's outside of consensus, away from the chair, and I've had other people tell me I didn't really hear much different from what the chair said 2 days later. So this is always a funny thing about communication. I can say something and people perceive it one way to the left, or they perceive it the other way to the right. So how people receive what I say is not always, you know, one clear vision of what it is. So I'll leave it up to people to decide whether there's a difference between the chair and I. But all I can do is say what my views are, and I've tried to be very clear what they are.
A lot of people are thinking at this point that Trump being Trump and mercurial, that the tariffs could change at any moment. Would you be reluctant to move rates not knowing that you've got any certainty about what's going to be happening?
Well, like I said, what we're going to look at is the data. I mean, that's how we always determine.
But does that leave you behind the curve?
You know, there's always that risk. You're looking at these things like, if is inflation going to get worse, is unemployment going to get worse, and you have to. It's a balancing act to make that decision. Hopefully, you're not late. And I think if we saw, that's what I said, if I saw enough movement in the unemployment rate to make me think that things were going bad, or growth prospects started tanking, or consumer spending started really going down, then I'd be ready to go. I wouldn't be sitting here waiting to determine whether the inflation is transitory or not. It's time to worry about the real side of the economy.
Can't let you go without asking about Fed independence, because it's obviously the other elephant in the room these days. Will the president backing off of his comments on firing Jay Powell make it a little bit easier for you all to do your job?
Well, I try to ignore all this stuff and just focus on the data and focus on doing my job. That's what I try to do every day. Criticism of what we do, that's the job. If you don't like being criticized, don't take the job. And the president's free to say whatever they want to policy, just like anybody else. But central bank independence, as we saw, I think, on Monday, is critical to the well-functioning of the U.S. economy. It has served us well. It allows us to do things in a non-political way. And it's something I worked on in my academic life, research-wise, for 20 years about the value of it. And I don't think there's ever been anything in the data that shows you that lack of independence is a good thing.
Well, would ad hominem attacks like we've seen on the chair make it harder for the next chair to do the job? Does the job itself get harmed?
I think it's up to like I said, it's up to the person that's in the chair. You take the job knowing you're going to be criticized from markets, from Fed watchers, from average consumers. That's part of the job. And if you don't like to be criticized, don't take the job. So it's really going to be a question of whoever the next chair is. Are they going to come in and keep the tradition of central bank independence, making policy in a non-political way? And for me, that's critical for whoever the next chair is.
Chris Waller, thank you very much for your time this morning. We'll send it back to you.
Thanks, Mike.
All right. That was Bloomberg's anchor, Michael McKee, speaking with Fed Governor Chris Waller in Washington, D.C., getting the thoughts of the Fed governor on a whole wide range of economic policies. We are here. This is the Bloomberg Intelligence Radio program. It is Isabel Lee sitting in for Alex Steele. I'm Paul Sweeney, and we're live here in our Bloomberg Interactive Broker Studio. We are streaming live on YouTube as well. Looking at the marketplace here, we've got stocks actually in the green here, so a little bit of a positive reversal from what we saw earlier this morning. The S&P up 43 points, that's 0.8%, and the NASDAQ up 228 points, that's 1.3%. We'll take a look at that throughout the morning. Let's take a look at some stocks on the move today. We're joined by Bloomberg's Vildana Heinrich. She joins us here in the studio. Vildana, what are you looking at?
I'm taking a look at IBM, shares of which are dropping some 6% today after the company reported results that showed strong profit, but also suggested the economic uncertainty and U.S. government cost cuts could be denting its business. So obviously this has been a theme that we've been discussing over the last couple of weeks, how White House policies are actually impacting companies themselves. So we're seeing more evidence of that. We have the CEO saying that in the near term, uncertainty may cause clients to pause. And obviously, IBM has been working to transform itself over the last couple of years. Shares had been doing okay up until this point. They were up some 12% for the year, so holding up a little bit stronger than the market overall. But we do see shares declining today.
What about Pepsi? It cut its full-year profit outlook. What are you seeing there?
Right. Shares of Pepsi are down 2.5–3% today. It's lowering its full-year profit outlook, and it's saying it's given the unpredictable U.S. trade policies, as well as worsening consumer sentiment, which is driving up costs and denting demands for the company's snacks and soft drinks. Obviously, it's an owner of a lot of brands that we're all very familiar with, and so it gives us a really good look and a pretty broad view into the state of the consumer.
Isabel and Vildana, are you soda drinkers?
I'm not much
Sparkly
of a
water.
soda. Yes, sparkly water.
So you're not like a Coke versus Pepsi. You've got a big opinion.
But if I were to choose, I think I like Pepsi more.
Is that right? Okay.
I would
I'm a
choose
Coke
Coke, I
person, but
think.
I'm not.
Can you put rum in Pepsi?
I think you can. I think you can. So John from the shore asking, can you put rum in your Pepsi? I think the answer is yes. American Airlines, what's happening?
But it's known as rum and Coke, isn't it? Not as rum and Pepsi. I'm sorry. American Airlines shares are down 0.5% today. It withdrew its full-year earnings outlook, and it's obviously joining a growing number of companies that are saying that unease about the economy is making it difficult to make forecasts and how the rest of the year will be playing out. Last week, we had United Air taking a very unusual step in offering dual earnings forecasts, so one for a stable environment and one for a reduced one based on the presumption of a recession. So again, just coming back to that theme of how policies are actually impacting companies and what they're saying on their earnings reports on how they're seeing things play out.
Yep, a lot of uncertainty. That's the key thing that we're hearing from some of these companies here as they report their earnings. Vildana Heinrich, thank you so much for joining us. Vildana is a cross-asset reporter for Bloomberg News, joining us live here in our Bloomberg Interactive Broker Studio. Coming up, Tyler Kendall, Bloomberg Television Washington correspondent, will join us to get the latest on some of the tariff news coming out of Washington. And Joy Yang, head of Indexed Product Management at Market Vector Indexes, to discuss her outlook for the markets here. And again, we have some green on the screen here today. S&P up 40.7%. The NASDAQ up 212 points. That's 1.3%. Yields come in just slightly. 10 years in, about 5 basis points. 4.32% on your 10-year Treasury. Bloomberg Dollar Index lower. This is Bloomberg. Good morning.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker, the Bloomberg Newsroom with this Bloomberg Business Flash, and we're being brought to you by Interactive Brokers. Trade over 10,000 U.S. stocks and ETFs, U.S. equity index options, U.S. treasuries, and more on your timetable. Learn more at ibkr.com/round-the-clock. Major stock averages right now, they are higher. Some of the individual shares in the move. You have IBM slumping, its results falling short of market expectations. PepsiCo lowering its full-year profit outlook. They're blaming tariff headwinds. And then you have P&G, Procter & Gamble falling. They cut their sales and profit outlook, citing tariffs and volatility in consumer demand. American Airlines withdrawing its full-year earnings outlook due to economic uncertainty. Still, Ed Yardeni at Yardeni Research told us earlier the Trump administration appears to be finally listening to some of the battered investors.
Clearly, the financial markets have had a big impact on the administration. This is the bond vigilantes and the stock vigilantes ganging up on the administration and saying, we need some moderation here, we need some cooling off, and that's exactly what the administration is doing.
Deutsche Bank strategists led by Pinky Chana slashing their year-end S&P 500 target by 12%. They're citing the blow to U.S. companies from the tariffs. S&P 500 right now 53 points higher, up 1%, 54.29 in the index. The Dow Jones Industrial Average up 147 points, and that's a rise of 0.4%. The Nasdaq 100 308 points higher. That is up 1.7%. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Isabel and Paul.
All right, JT, thank you so much. We appreciate that. Isabel Lee sitting in for Alex Steele. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio. We are streaming live on YouTube as well, so go over to youtube.com, search Bloomberg Podcasts live and all that kind of stuff. You'll find us there. Let's get the latest reporting from Washington, D.C. on the tariffs. It is a fluid situation, to say the least. Tyler Kendall, she's been following it for us. She's a reporter for Bloomberg News. She is down in Washington, D.C. So, Tyler, is there a sense in D.C. at the White House that perhaps this tariff policy could be more, measured or more consistent or more formal? It seems to be a little bit ad hoc here, and that's one of the reasons maybe the markets are a little spooked.
Yeah, hey, Paul, there's a lot of mixed messaging currently at the moment when it comes to tariff policy related to China, even with China saying earlier today that there currently are no negotiations happening between Beijing and Washington, calling reports about recent developments to be groundless. That was particularly interesting after President Trump yesterday in the Oval Office contended when he was asked if he's actively involved in negotiations with China. He said that, quote, everything is active. Now, we do know that there were some preconditions that Beijing does need to see before talks can really kick off, including that they would like a point person other than President Trump to lead the negotiations, but he still says that he is very much directly involved here, even though we haven't gotten any real confirmation that Xi Jinping is willing to pick up the phone moving forward. At the moment, the latest escalation is that Beijing is now calling on the U.S. to eliminate all unilateral tariffs, something that the Treasury Secretary Scott Bessent said yesterday really is just not an option on the table. But when it comes to this back and forth in the mixed messaging yesterday, again, in the Oval Office, President Trump saying that he does think that 145% levy on Chinese imports is very high and that it's leading to essentially a trade embargo, which has prompted some to think that that levy very much will end up being lower here. But then at the same time, he followed that remark by saying that if a trade deal with Beijing is not reached, that will ultimately be okay because the U.S. will just set what he called a, quote, fair price. He then suggested that the White House is preparing to release some revised tariff rates for all countries, including China, in the next 2 to 3 weeks, ultimately. So we'll have to see how that ends up developing here, but it's something that we're closely watching if we are going to get some potentially new tariff rates.
Talk to us more about China's attempt to repair ties with the European Union and as it tries to prove itself to be the more reliable trading partner compared to the U.S. What exactly is Beijing doing?
Right, exactly. So trying to reach out here to the European Union in a bid to try to shore up ties as a counter against the U.S. Most recently, we have reporting, for example, that European Union leaders as well as Xi Jinping were actually together on a call having to do with climate change. Now, there has been sort of a distance between the European Union and China, particularly when it comes to their criticism of how China has assisted Vladimir Putin amid the ongoing war in Ukraine. But there does appear to be some easing here, particularly when it comes to negotiations around electric vehicles. So this is a very important partner that we are watching, particularly as there hasn't really been that much movement when it comes to talks between the U.S. and the European Union. You'll recall just a few weeks ago, the EU's trade chief left Washington with very little clarity, according to our reporting, about exactly what this White House needs needs to see done in order to get a deal. And then I would also just quickly highlight one other trading partner, and that is Japan. There is new reporting this morning from Bloomberg News, according to Japanese officials, that if the U.S. ends up asking Japan to curb its own trade against China, they will push back on that. We should make clear our reporting indicates that the U.S. has not asked Japan to do that just yet, but we do know it's something that this White House has been mulling. And also, importantly, China has come out and said that it will take its own countermeasures against any countries that try to realign here, particularly when it comes with the U.S. And what Treasury Secretary Scott Bessent has floated could be a plan to then approach China as a bloc. One statistic that I'll leave you with is that China does about 20% of its commerce. Japan does about 20% of its commerce with China. That is more than it does in trade with the U.S., but at the same time, the country does export more material to the U.S.
Tyler, thank you very much for your reporting. Appreciate you taking a few minutes. Tyler Kendall, she's a reporter for Bloomberg News. She is based down there in Washington, D.C., giving us the latest on the tariff situation. It is a fluid situation, to say the least. The market seems to be hanging almost on every tweet here. So right now, the market is higher. S&P 500 up 63 points. Let's get back to discussions on this market. Joy Yang joins us here, head of index product management at Market Vector Indexes. Joins us here in our Bloomberg Interactive Broker Studio. Joy, thanks so much for joining us here.
Thank you.
How are you approaching these markets these days? The volatility is significant. We've got a VIX 27. We've got the MOVE index showing some volatility in the fixed income market. How are you guys approaching the markets?
I think, as with everybody, we're in new territories. Nobody is certain what the outcome of this tariff negotiation is. And even if we do reach a positive win-win outcome for every party involved, which is the best case, I think there's still going to be uncertainty around how long will this last? What are the second and third order impacts? So I think this is structurally a new environment for everyone, which is we're at elevated volatility. Uncertainty will remain high. So I think for us, we're watching indicators, and those are gold prices, Bitcoin prices, on what investors are thinking. And at the moment, businesses can't make decisions. They can't give proper guidance, and those who have, investors can't rely on those. So I think people are really either parking their money into safe havens or seeking liquid assets which they can move in and out without kind of structural damage that we're seeing across asset classes.
I feel like with all this political rhetoric, people are maybe forgetting that it's earnings season and we are in the thick of it. And around 44% of the S&P 500 companies that have reported mentioned the word recession. That's a little higher than the previous quarter. What is your read on earnings so far? It's also been interesting. Companies have withheld forward outlook, or they've had two scenarios, the base case and the tariff case. What is your read on those?
I think it's probably impossible to rely on this quarter's earnings guidance. And this is going to be short term. So I think it's still prudent for investors to focus on the long term and really focus on the fundamentals, which is, we'll get over this. There's got to be something after tariff negotiations. And I think structurally every industry still has a story and narrative that's focused on the long term. If you're in AI, that's a real story, right? Innovation will not break down, disruption will not break down. But, at the moment, there's so many things shifting that to give any kind of short-term guidance is really not reliable.
Talk to us about the risk-controlled indexes, ETFs, the Market Vector Gamma Road U.S. Equity Strategy Index. Hike, what is that?
Yeah, so I think this is the type of strategies that I think investors should be focused on, because I think we're so focused on equities and fixed income, right? But, you really have to think about other alternative ways of looking at the world and structuring portfolio solutions. And one is to look at these indicators out there that are independent of any single country or any single asset classes to understand how elevated uncertainty is, or what sentiment is. And I think right now our Gamma Road Index is telling us to get out of equities. But if you're out of equities and you're sitting on cash, that's not a great place either, as we've seen the dollar weakening and weakening. So I think investors should also look at alternative assets like gold or Bitcoin that are not driven by the same macro factors.
It's interesting. Gold, as we know, is just ripping, but Bitcoin as well. And I feel like with Bitcoin, it's you choose the narrative. Some people would say it moves in lockstep with tech companies like the Qs, but some would say no, actually it's an inflation hedge. I feel like it's still figuring it out. But can you talk to us about how different this is, this global macro shock compared to others? Because you said let's look at the long term.
Yeah, so I think definitely when you mention you're choosing the narrative, is because this is still a nascent asset class. And we've seen a structural shift in Bitcoin also because it is a very volatile asset, but fundamentally, it should act like a store of value. So we're seeing this as speculative players move out and we get more institutional players and more clarity around regulation. We're seeing it bring out the strengths that Bitcoin naturally has, which is it's immutable, it's decentralized, so it's not dependent on any single government, and it doesn't require trust because trust is built into the code. And fundamentally, what we're seeing is that investors have lost trust, whether it's U.S. assets or just the correlation that happens between equities and bonds. So they're looking for things that, they can actually depend on. Right now, we're seeing gold and Bitcoin as one of those assets.
How about international markets? People have been selling the U.S., whether it's the dollar or stocks, and maybe putting their money internationally. How do you think about that?
I think if we take a step back, I think the problem was people had too much bias towards U.S. assets and weren't really reflecting on where relative value is happening. And if you still look at international markets, even though globally every market has dropped, international markets still look cheap. They still look better from a PE valuation point of play. So if you're focused on fundamentals and not sentiment, this is a better place to be in. We're seeing
Does that include emerging markets as well?
It includes emerging markets, but all markets will be impacted by tariffs.
Yep. So that's kind of the issue here. But so we'll see how it plays out. But again, we've got green on the screen here today. Joy Yang, thank you so much for being with us. Joy Yang is head of index, product management, and market vector indexes. Joining us live here in our Bloomberg Interactive Brokers studio. So I'm seeing the market trading higher here. This will be third day in a row. So I mean, Isabel, is this a trend?
I think that's the big question, whether this is we've hit the bottom, or what is the next driver going to be? Is it earnings? Is it policy? Is it eco data, hard data, soft data? So it's really hard to tell.
See how that plays out. Coming up, we're going to check in with Damien Garda, Bloomberg Health reporter on Merck. Merck is expecting a $200 million tariff hit amid some of their outlook. So that was a little bit concerning for the folks at Merck. We'll take a look at some of the outlook for Merck and for Big Pharma coming up in just a moment. S&P 500 up 70 points this
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with these Bloomberg Business Flash. Major averages all higher right now. The S&P 500 up 71 points. That is a rise of 1.3%. The Dow up 283 points. The NASDAQ 100 right now up 249 points. That is a rise of 1.9%. You had several companies, including Texas Instruments, American Airlines, and PepsiCo, lowering their earnings outlooks or withdrawing them altogether because of uncertainty surrounding tariffs on the economy. More evidence the U.S. economy's prospects may be sinking. Factory orders for business equipment showed little change in March. Kind of illustrates the uncertainty stemming from the trade and tax policy. Another thing to toss into your investments, salad. Beijing denying there were talks on reaching a trade deal. Meantime, Jean Boivin at BlackRock says there are elements of the U.S.-led trade war that just don't add up.
We've built this, international trade framework for many decades, and there's no way to flip and close current account deficit, and at the same time rely on foreign investors to finance 30% of the debt.
Do yields here, 2-year, that's down 7 basis points, 380. The 10-year, the benchmark, that's down just about 7 basis points. We're at 431. Here's one for you. This is according to the Journal. There is a rush of applicants in this new tariff regime to become a U.S. licensed customs broker.
Nice.
So this job, you handle it sounds very tedious. You handle the paperwork to process imports, then you calculate the duties and fees for products brought into the U.S., but you have to pass a test, 4.5 hour. It's an open book test.
My kind.
Covers the technicalities of classifying merchandise and entry and valuation procedures. Exam takers who, you have to be a U.S. citizen, 18 years or older. It's an 80 multiple choice questions. They're deliberately obfuscating, is what we're told. One of the last exams, 2019, the pass rate was 4.2%. So I don't know. I'll have to skip, even though it's open book. Anyway, we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That is your Bloomberg Business Flash, Isabel and Paul. And remember, tariffs.
I know.
You pay.
I know.
When it comes into the U.S.
That's what I learned.
It's not like the country that's exporting it pays it.
I know, exactly. And we're not tariffing countries. I've been told we're tariffing goods. We're putting tariffs on goods, not countries.
So you go to Port Newark to go pick up your whatever, you got to pay.
Yep, absolutely. John Tucker, thank you so much. We appreciate it. Isabel Lee sitting in for Alex Steele. I'm Paul Sweeney. We are live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well, so check us out over there. Merck reported some earnings. They actually put a number on the tariff cost for them, $200 million. I mean, for Merck, it's got a market cap of like $200 billion. So $200 million doesn't seem like that big a deal, but at least it's a company putting a number on what they see is maybe some of their costs there. Damien Garde joins us here. He's a healthcare reporter for Bloomberg News, joining us live here in our Bloomberg Interactive Broker Studio. Damien, what did we hear from Merck today? What did they report, and how did they talk about tariffs and maybe some of the costs they see?
Well, it's interesting because, as you mentioned, they disclosed that $200 million, that's what they expect in 2025 to pay on account of tariffs. But these are just already announced tariffs. So principally the ones affecting imports from China of certain goods, and then obviously exports to China, the retaliatory tariffs that we know about. And so there's a lot of interest in this because in the pharmaceutical world in particular, there's a huge anxiety over how the kind of like sword of Damocles of specific pharmaceutical tariffs might affect the industry, what the percentage will be, how they might shake out. So Merck giving us at least some sense of how it's been so far is helpful. But listening to the earnings call, it's like a certain form of theater where analysts find new and inventive ways to ask the company, will you tell us what you're actually expecting from pharmaceutical tariffs if they come through, as the president has promised to bring them about, and Merck kind of artfully dodging actually committing to that.
How exposed is Merck to China and maybe broader pharma companies in general? Because they do have this drug, and they're facing stiff competition in China, and that's one of the really downfalls that the company faced in the previous quarter.
Yeah, I think Merck in particular faces tariff issues on two fronts. One, the retaliatory tariffs imposed by China make it difficult to sell products into China for any American company. They're sort of in the crosshairs of what Beijing is doing in retaliation to the White House. But then, maybe an even larger headwind for them is the potential of the United States imposing tariffs on the importation of pharmaceuticals, because Merck, like most of its peers, has a huge global manufacturing network, and in many cases will ship products to the U.S. from, for example, Ireland, where they have a lot of manufacturing. And then this gets a little into the weeds of trade policy, but Merck, like many companies, has offshored the intellectual property behind some of its biggest drugs. So Keytruda, the biggest drug in pharmaceutical history, which is Merck's cancer drug, the IP lives in Ireland. And so that gets complicated.
Ireland, okay.
That gets complicated in that and these are all ifs because we don't know, but if, for example, the president were to impose a 25% tariff on pharmaceuticals, then Merck could end up paying quite a bit simply to import its own product and basically the intellectual property of its own product from Ireland to the United States. So that's really the number that analysts are trying to get their heads around, both in terms of Merck and in global pharmaceuticals in general, and it remains a mystery because we don't know.
Merck based where, John Tucker?
That would be New Jersey.
That would be New Jersey. Yes, it would be Rahway, New Jersey, Johnson & Johnson, New Brunswick, New Jersey, just for those out there wondering. And we got Shearing Plow, Bristol Myers Squibb, all over the state.
I still have to visit New Jersey.
I have to visit New Jersey. How long have you been in New York?
7 years.
Jeez.
But I stay in the city.
Oh, please.
You are really missing out.
Jeez, all right. Damien, all right, so frame out Merck. I mean, the stock is down 21% this year to date. That's the worst of the big pharma here. I've got Eli Lilly up 10%. What's the story on Merck? What's the concern in the marketplace about Merck?
I think it boils down to Gardasil, which is Merck's blockbuster vaccine for HPV, which is a cancer-causing virus. It's one of the more, it's the only vaccine you can say prevents cancer. So this is a massive product around the world that Merck developed and has been marketing for more than a decade. The issue came about last year related to China, which is that there had been this massive boom in demand in China for this vaccine, which is paid for out of pocket. It's a luxury product for basically the wealthy of China. And then suddenly that demand seemed to fall off a cliff last year. And Merck didn't have initially much in the way of convincing explanation as to why that happened and why it might ameliorate. And slowly, quarter after quarter, the story got worse until in the first quarter of this year, they halted all shipments of Gardasil to China. So
voluntarily?
Yes, because the inventory had built up. The demand had fallen off a cliff such that their partner in China was apparently unable to sell the doses at the level that they were previously scrambling to meet the demand of. And so if you just subtract all of Gardasil's potential revenue in China, you're probably talking about $3 to $4 billion a year, which as you mentioned, in the context of Merck is not that big of a deal. And especially Keytruda, the cancer drug, can make that up in half a quarter. I think the issue really with the stock move you mentioned, and they're down 40% since first disclosing the Gardasil problems in China, relates to the fact that the company has not had a very convincing explanation for why it happened and why it's going to be ameliorated. And so you're seeing both a sort of, reputational kind of risk taking place there, and then furthermore, not unlike Wile E. Coyote running off a cliff, I think when the Gardasil situation worsened, investors started taking a hard look at the rest of Merck's portfolio heading into the rest of the decade, especially Keytruda, which will face lower cost competition around 2028, and kind of start to panic. Like, are we sure this company has a plan to withstand what's going to be a massive patent cliff?
What are your sources telling you? Why are they not explaining it then?
I think in fairness to Merck, I think they have been probably about as forthcoming as they can be. It's a little bit of a black box for them because, as I mentioned, they do business in China with respect to Gardasil through a Chinese company that is their distributor. So Merck on the US end is basically shipping doses according to what that company orders. They don't necessarily have, as that company would, the sort of like boots on the ground selling doses in China. So I think they were probably caught a little flat-footed, and I think reasonably you could say that they didn't read the market well. We had a story earlier this week looking at the rise of biotech companies in China, which have rapidly come to develop vaccines of their own and are now seeking to supplant Gardasil in the country. And I think it's fair to say, and we've heard analysts say this, that Merck did not adequately assess the competitive dynamics on the ground there.
Where is the University of New Mexico?
Albuquerque.
Okay, and you're from New Mexico originally?
That's right.
Like a native?
Oh yeah, in fact, I'm going back in a month. Virtually everyone to whom I'm related lives within about 100 miles of Albuquerque.
No kidding. So what town were you born in?
Los Lunas.
Los Lunas.
So it's south of Albuquerque, between Albuquerque and the Isleta Indian Reservation.
That's west of New Jersey.
That's west of New Jersey.
Little west of New Jersey.
Have you been in New Jersey?
I have.
See?
Delightful place.
All right. Damien Garde, thank you so much for joining us. Damien Garde, healthcare reporter, Bloomberg News, proud graduate of the University of New Mexico. They are the Lobos. This is Bloomberg Morning.
Listening to Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, we got Isabel Lee, Paul Sweeney. Alex Steele's out. She's doing something on the energy patch there. I have no idea. She'll be back tomorrow. But we're here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube as well. Talk about UPS bolstering its health unit, the $1.6 billion deal for And Lauer. What is that all about? Lee Klaskow joins us. Lee, talk to us about UPS. What's going on there?
Yeah, so this is really part of their overall strategy of doubling their cold chain healthcare business to about $20 billion in sales by 2026. They've done a number of, I would call them, because given the size of UPS, tuck-in acquisitions to kind of supercharge that business. Obviously, they're trying to grow organically, but I think a lot of the growth is going to probably come through M&A, and it's been a great business for them, and it's a business that they've been targeting because it has higher margins than their legacy, deliver a package to your doorstep business. This is stuff that has, call it like mid-teen margins versus, anywhere between 8 and 12% margins of some of their other stuff. And, they're trying to really kind of recreate themselves, if you will, because, the market has changed on them. There's been an increase in home deliveries, business to customer, consumer deliveries, which tend to have lower margins, and a lot less of, they go to a law office, they deliver 20 envelopes and they pick up 20 envelopes, which tends to be, a lot better business. So, what they're really trying to do is focus on higher margins, and this part of the supply chain is a better business, and it tends to grow well beyond GDP growth.
It's definitely higher margin because if you need medicine shipped overnight in a refrigerated box, you will have it shipped. What else are they looking at when it comes to higher margin businesses, or for now, is it just healthcare?
Well, they also want to focus on the small to mid-size shippers. Those shippers tend to be a lot more profitable. They're kind of looking to, divest their exposure or reduce their exposure significantly to really large companies like Amazon. And, they'd rather have the capacity available to this, small to mid-sized shipper, which again is a higher margin business. And again, this is all, driven by the fact that the market has changed on them. The share of B2C is increasing, and they're really becoming more of a focused company. Over the last couple of years, they divested from their freight brokerage business, which was called Coyote. They also, a couple of years ago, sold their less than truckload business, and they're really trying to focus on the parcel delivery business and some of these, value-added business like we see in cold chain healthcare supply chains.
Lee, you cover the railroads, the truckers, the maritime shippers, the air freight. I mean, you cover the entire transportation logistics space globally here. Your companies, like no other, have their finger on the pulse of global trade here. What are you hearing from your companies about just business conditions globally?
You're absolutely right. They have their pulse on the kind of economy. I think they're trying to find the pulse right now because there's so much uncertainty in the marketplace that, they just really are kind of doing a wait and see. We were somewhat surprised. A couple of our companies that we cover, like Union Pacific, which reported earnings that were slightly below expectations this morning, they're maintaining, their outlook. A couple other companies have been maintaining their outlook, which to us was very surprising. Like, because going into earnings season, we thought, earnings expectations would be lowered by, or they would just, just say, these targets are no longer reliable. So, we're just not going to provide anything because we just don't know. We had a couple of trucking companies that lowered their expectations, but overall, we've been pretty surprised about the outlook. That being said, I think it's really being driven by the fact that they really don't know what's happening. I mean, we are hearing that, there are less ships leaving China to come to the U.S. Hapag-Lloyd, which is a major shipping line, there were press reports out that said their China to U.S. voyages or bookings are down around 30%. So, what we're seeing, at least at the early stages as it starts in China, the impact from the tariffs or the threatened tariffs on Chinese companies.
What else are the headwinds that you're hearing? I mean, apart from tariffs or just apart from the economic woes, just those two, no biggie. But what else are you hearing from the companies that you cover?
Well, shippers are scrambling, right? They realize that, they don't want to pay 100% plus in tariffs. So they're trying to find alternatives. Kuehne + Nagel, which is a big freight forwarder, they reported earnings very early this morning. They're based out of Europe, and they noted that, they're seeing a lot more activity out of Southeast Asia, like places like Vietnam, as maybe, supply chains are shifting where they can to kind of avoid the tariffs. And some of this, will be interesting to see how it plays out over time. And the reality is it's really going to be dependent on, what's happening in Washington. If these protectionist policies stick, are they negotiating tactics? Where are we? What's announced in the morning, is it really going to be executed on, or is it they're just going to walk back in the afternoon? So there's so much uncertainty out there on the demand side, and we are seeing that taking a toll on the overall economy, and it's definitely pushing out the freight recovery. You know, we were pretty bullish in January, in early January. We thought, you know, the new administration, lower taxes, less regulation, that's going to be good for business, and we thought, you know, truckload rates, which is really, you know, the beginning of the supply chain, we're going to be in a lot better shape than they are. Gotcha.
All right, Lee, thanks so much. Appreciate it. Lee Klaskow, Bloomberg Intelligence. All right, folks, for our listeners in the U.S., a reminder, you can listen to us via satellite radio on Sirius XM 121, access the world's only global audio business network, coast to coast, 24 hours a day. Bloomberg Radio on Sirius XM channel 121 is presented by Oracle. Stay with us for more Bloomberg Intelligence.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been in U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, coming up, folks, we're going to drive this conversation forward. We got stock markets moving higher. Coming up, we're going to speak with Geetha Ranganathan, Bloomberg Intelligence media analyst. I'm going to ask her about Comcast. They reported some numbers today. That's got to be a tough business, cord cutting and all that. We'll get the latest there on the Comcast and the cable business. George Ferguson, Bloomberg Intelligence senior aerospace analyst, is going to talk to us about what's happening in the airlines. We've got American Airlines pulling its outlook for the year. So a lot of uncertainty in the airline business there. Barbara Goodstein, managing partner at R360, to discuss her outlook for tariffs, the markets, and what she foresees going forward. Michael McKee, I'm just going to say, hey, what do you want to talk about on the economic front? He's down in D.C. at the IMF meeting, so we'll see what he's picked up down there. He will give us his thoughts. But first, let's go to John Tucker for a Bloomberg Business Flash.
And it's his interview that's actually driving markets, I'll say right now. Investors seem to have latched on to the idea the Fed could cut rates sooner than anticipated to prevent recession. You heard him right here on Bloomberg Radio with Mike. The Federal Reserve Governor Chris Waller said firms may begin laying off more workers with aggressive tariff levels, and he'd support rate cuts in that scenario to protect the U.S. labor market. So that's pushing the major stock averages higher for now. The S&P 500 higher for a third straight day. You have Alphabet. They're expected to set the tone for the industry's earnings season, and they're going to report after the close of regular trading today. In the meantime, Mike Wilson, chief U.S. equity strategist at Morgan Stanley, says it won't be easy, but big U.S. companies should be able to navigate the trade war turmoil.
I would still bet on, Fortress America from a corporate, from a corporation standpoint, that they're going to be able to kind of mitigate and manage this, at least the larger cap quality companies for sure. So, this process is ongoing.
Among the most active, shares of Comcast down 4%. They lost customers due to growing competition from streaming companies and wireless providers. S&P 500, 63 points higher, up 1.2%. The Dow up 231 points. That's up 0.6%. The Nasdaq 100 up 322 points. That is up 1.7%. This sort of caught my eye before. The number of new foreclosure cases increasing 45% from the fourth quarter of last year to the first quarter. The increase suggests more borrowers may be defaulting on their mortgage obligations. Keep an eye on that one. We check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Guys.
All right, John Tucker, thank you so much. Isabel Lee sitting in for Alex Steele. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio in New York City. We are streaming live as well, so head over to youtube.com, search Bloomberg Podcast Live, and that's where you'll find us. As John was just reporting, we've got a pretty strong tape here today. Let's look under the hood and see where individual names are moving. We can do that with Natalia Kanijevic, equities reporter for Bloomberg News. She joins us here in our studio. Natalia, what are you looking at?
Guys, let's start with consumer names. Procter & Gamble shares are down by 5%. The company is cutting its annual sales and profit outlook. Of course, it's blaming volatility, uncertainty around tariffs. It's really difficult to predict consumer behavior. Procter & Gamble sees organic sales growth this year at approximately 2%. In January, it said it was supposed to be somewhere between 3 and 5%. Earnings report showed some deterioration in sales here in the United States. However, it was a slight improvement in China. China is the second largest market in terms of sales and profit.
Really?
It was down by 2%. Sales were down. Revenue, excuse me, was down by 2%, but it was a slight improvement from a 3% decline that we saw in the past quarter. So, of course, everyone wants to know, will the company increase prices? And the CEO said it will likely roll out price increases during the next fiscal year, which starts in July. But before that, it will try to shift some sourcing, readjust supply chains, and maybe some formulas to reduce exposure to tariffs.
And you know what? One of the great functions on the Bloomberg terminals is the PGEO function. And what it allows you to do is to see kind of where revenue comes from and things like that. So it breaks down North America, Europe, Asia Pacific, Greater China, and EMEA. And you're right, Procter & Gamble is a global company. So they're going to feel it. And if they're lowering their guidance, that says something. What else you got?
Airlines, of course, we are watching American Airlines earnings report. Shares are actually up slightly, less than 2%. It dropped full-year earnings outlook, and a similar move we saw from Delta, Frontier, Southwest Airlines. Of course, the company is saying it will provide a full-year update once the economic outlook becomes clear. Now, we also see that overall, American Airlines profit margins continues to trail peers. BI put a nice note breaking down this earnings report. But I would also like to highlight a commentary from International Air Transport Association Chief Willie Walsh. He said this overall impact from tariffs on airline industry would be very similar to what we saw after September 11th, 2001 attack. So he said it will be very severe, but potentially short-lived, and we may see a bigger impact on transatlantic traffic. But however, he said potentially the airline industry will recover in the next few months.
Paul, I just tried PGEO, and the biggest revenue of P&G is fabric and home care, followed by baby, feminine, and family care, and beauty.
Yeah,
what about? I know, it's interesting. Thanks for teaching me this function.
It's a good one. Anything else, Natalia?
Yes, commodities, Newmont.
Oh, right. Yep.
Big move. Shares are up year to date, guys. It's one of those rare examples of winners. Shares are up by almost 25%. Better results are, of course, driven by rising prices of gold.
All right, very good. Natalia Kenijevich, equities reporter for Bloomberg News. Appreciate that. Market Drivers today is brought to you by Commonwealth, supporting more than 2,000 independent financial advisors with a 2-to-1 advisor-to-staff ratio. Small firm attentiveness, big advisor impact. Go to commonwealth.com to learn about their consultative support and technology. Red headline crossing the Bloomberg terminal there. Trump asked Supreme Court to allow his transgender military ban. So there we go. We'll have more reporting on that, but continue to say more activity coming out of the White House there. Comcast, one of the companies that reported today, tough business in terms of keeping their subscribers for not only their television business, but also their broadband business. So we see subscriber losses there across the industry, and that's a tough thing to manage against. Geetha Ranganathan joins us. She covers all the media companies for Bloomberg Intelligence. Geetha, talk to us about Comcast, because Comcast, in my personal opinion, they've got one of the best management teams that I've come across, period. They always have had a really strong management team, but the reality is the business conditions, there's a lot of headwinds out there.
There absolutely is, Paul. So Comcast is the largest broadband provider in the United States. They have about 32 million subscribers. So they are by far the number one. But the problem for them over the past few years has been really rising competition, very, very intense competition from the likes of Verizon, T-Mobile, and AT&T, who are making this big push into the broadband business and really going after Comcast's bread and butter. So just a few years ago, Comcast used to add about 1 million subscribers every year in its broadband business. Today, when it reported, it reported a loss of about 200,000 subscribers just in the first quarter. So tremendous pressure that they're feeling from both fiber and fixed wireless access, which are, the two products that telecom is really pushing. And it's going to, the pain is definitely going to last through the rest of the year for sure.
What are they doing to stem those subscriber losses?
So the problem for them is on the fixed wireless product, which is really very, very easy to use. It's kind of a plug and play type of a product from the telecoms. The main problem that Comcast is facing there is the price point. So there is a lot of transparency. The price point, first of all, with fixed wireless is much lower than a traditional cable broadband subscription. And so they're facing a lot of pressure there from a pricing standpoint. And then with the fiber product, it's really more of a quality concern because the cable product is definitely a good one, but it's not as good as fiber. So they're getting hit really on both ends of the spectrum, and they are now they are kind of trying to change their whole strategy. They've called for this strategic pivot in this go-to-market strategy, and what that basically entails is kind of changing up their pricing and packaging. The problem with Comcast is it's really been a very regional pricing strategy, which has resulted in a lack of transparency, I think, and that's made customers a little bit furious. So what they're trying to do now is kind of offer more of this normalized or uniform pricing across their entire footprint, make it more comparable with the telecom broadband offerings, and hope to gain some of those subscribers back.
Geetha, what are they going to do with their cable networks?
They are planning to actually spin that business off, Paul, a little bit later this year. As you know, the cable network business, yes, it throws off a good amount of cash for Comcast. That's about almost about $2.5 billion in EBITDA, but that has been declining because of the pressures from the cord cutting, from cord cutting, really both on the advertising side as well as on the affiliate fee side. So, we're hoping that once they do that spin, the rest of their media business, which is, the NBC film studio and especially the theme parks, can actually get a much better valuation, because right now what has happened within Comcast is NBC is kind of totally neglected, I would feel, and Comcast, despite having really robust financial metrics, seems to be a very unloved name with media investors.
So, but the big thing for me on Comcast is the Universal Studios. Yeah. Tell us about Orlando, Florida. They're opening up a huge park there next month. I'm ready to go. Tell us about that.
I know. And there, it's, of course, Epic is the big news for this year. They've made huge investments. This is a park that is going to be one of the biggest attractions added in Florida for over, many years now. And we're expecting about 10 million, 10 million visitors per year. So this really substantially increases the attendance for the Universal Parks. I mean, the Universal Parks typically get about 25 million visitors every year compared to Disney, which gets about 50 to 60 million in Florida alone. Wow. So this is really Comcast going after Disney in a big way and kind of increasing their footprint all over the world. And it's not just Epic. In about 4 to 5 years' time, they're actually going to open this new theme park in London, which again should, increase their international footprint. So they are really going after the theme park business in a very big way, Paul.
Yeah, absolutely. I'm going. I'm telling you right now. I know John Tucker's going to be down there as well.
I don't leave New Jersey.
You got Great Adventure, Six Flags.
That's all
you're not going. All right, very good. Geetha Raghunathan. She is the media analyst for Bloomberg Intelligence. Appreciate getting some thoughts there on Comcast stock trading down. And again, tough business there with all that cord cutting. That's been just a brutal situation. Switch gears. Let's talk airlines. American Airlines pulled guidance. I mean, we're seeing a lot of that. A lot of companies taking down their guidance just because of economic uncertainty out there. And the companies that do have guidance, a lot of those companies are pulling their guidance. American's one of them. So we want to get to the bottom of it. So we talked to George Ferguson. He's actually in studio. He's not out on a sailboat somewhere. He's in studio doing some work here. He covers all the airlines and aerospace companies for Bloomberg Intelligence. George, talk to us about, first, just what's happening at American and what's happening with air travel.
So, what's happening at American, look, I think the quarter American looked about what we expected. They're also citing softening demand in the marketplace, and I think they're pointing largely to leisure. We're seeing load factors kind of fall at a lot of companies, right? They're trying to hold fares up, and load factors are sort of caving in because they just can't get the demand to fill the airplane. So it feels like later in the quarter they were starting to have the breakdown in demand, right? Because they probably, they kind of sell these seats at certain gating points. They try to have the airplane filled at certain gating points. And when you don't make your load factor, it means as you got to the flight time, you just couldn't get people to take that ticket price. So it seems like Demand is kind of faded over the quarter. Again, they're citing leisure, and so that's been the knockdown in load factors. And so to us, we saw that at Southwest as well. To us, it looks like capacity's got to come out of the marketplace, right? But these companies are still managing a lot of expense inertia, right? Americans still saw cost per available seat mile rising mid-single digits, right? So that's a heavy level of inflation inside the business. It's going to be hard to cut capacity, which you need to do to firm up fares, and not have those costs balloon. So we're seeing that kind of across the industry. It'll be very interesting to see how they try to address that.
So if domestic demand and travel has waned, what about international?
Yeah, so I mean, we're watching international closely. So what we're hearing is domestic leisure. We're getting told that domestic premium is holding up, and international has done pretty well as well. The first quarter is typically not a heavy go to Europe kind of period. So a lot of them cut capacity, and they saw really nice yields, which are synonymous with fares during the quarter. So it looked okay. But I think if you look closely at the euro, I don't have the absolute current spot on the euro.
113.
Yeah, but so we're up 13% on the euro. Things are getting very expensive to go to Europe. Now, look, everyone's not going to stop going to Europe. Usually that's a more well-heeled crowd. They book further out in the curve, right? I think I have a joke, like I think everybody gets up, Christmas morning, and they open their presents, and then the well-heeled families go, so we're going to Madrid this year, or we're going to Barcelona, right? And so I think they've already got their plans in place for this year. But our guess is, especially for second quarter, but our guess is third quarter, we could see some softening in Europe, and that's really been holding up the U.S. airlines' profitability well. One thing I'd point out real quick on that is really the U.S. carriers are flying Americans to Europe because Europe was cheap.
Yep.
Europeans aren't coming here.
Yep.
So the question is, if the euro flips here, will the Europeans come here given maybe a little bit of the political climate? Maybe we've seen a little heavier inflation. You go to dinner in New York, it's not dinner in Madrid. That's the question I have, and I think we'll see it as we get into 3Q, whether or not that's going to hold up.
The American Airlines execs joining Delta Airlines and saying they're not going to pay more for airplanes because of tariffs. How can they say that? If the price is going up because of tariffs, are they just not going to take planes?
So Delta did flatline the back half of the year on capacity, and I think part of that was in reaction to reaction to tariffs and not wanting to take deliveries and not to shoehorn themselves. Look, I think a lot of the CEOs don't believe this is going to go on for long. We've done some analysis at Bloomberg Intelligence, and if you look at the markets, if you look at Europe and at the U.S., and you look at Airbus and Boeing market share, Airbus has almost as strong a market share in the U.S. as Boeing does.
Wow.
So the Europeans are going to have to find some way to fix that problem. I think these CEOs think it won't last. They don't want to pay up right now for it.
All right, very good. We'll say a little game of chicken there. We'll see how that plays out. George Ferguson, Senior Aerospace Defense and Airlines Analyst, Bloomberg Intelligence. I mean, you get him in New York, you got to get him in the studio, because to get that guy out of Princeton, I mean, you got to have a shoehorn. I mean, let's be honest here. These guys have gotten comfortable down there. He's got the sailboat there. He's got the whole thing. Wow. He's got it all played out. Now he's down at the shore. It's a short drive from Princeton to the yacht club, as they say. S&P 500 up 78 points. That's 1.5%. NASDAQ up 330 points. That's 2% here. Markets moving higher. We'll have more coming up. This is Bloomberg. Good morning.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. The major stock average is higher right now. You have 10 of the 11 major industry groups in the S&P 500. They are up. Looks like tech stocks, information technology, and communication services, they're in the lead. And after the close of regular trading, we're going to get results from Google parent Alphabet. PepsiCo lowering its full-year profit outlook. That's because of tariff headwinds. Procter & Gamble falling. It cut its sales and profit outlook, citing tariffs and volatility in consumer demand. And then you had American Airlines withdrawing its full-year earnings outlook due to economic uncertainty. A posting, President Trump saying on Truth Social just a few minutes ago, Boeing should default China for not taking the beautifully finished planes that China committed to purchase. Right now, the S&P 500, 74 points higher. That's up 1.4%. 5450 on the index. The Dow Jones Industrial Average up 275 points. That's a rise of 0.7%. NASDAQ 100, 2% higher, up 370 points. I did have some economic data. Sales of previously owned homes falling in March by the most since 2022. You want to guess what the median sales price is nationwide?
What?
I know you're eventually going to be in the market for this. $403,700.
Average price of a house?
Yeah.
Wow.
That's up 2.7% actually from the
It's a whole
year-ago
housing
period.
affordability thing that is just brutal for
I don't know
young
how
folks.
Millennials are just really doomed.
You can always move into my basement with your husband. I'd love to have you. You were talking about Epic.
Yep.
Well, once confined just to like around Halloween, monster and horror theme attractions are actually becoming fixtures of theme parks the entire year as they try to bring in some new revenue. Chill-inducing attractions in the works across the U.S., including from Walt Disney, as the entertainment industry looks to capitalize on growing interest in all things spooky. As if things weren't spooky enough out there. Let's get more spooky stuff. Anyway, we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Isabel and Paul.
All right, John Tucker, thank you so much. We appreciate that. Isabel Lee, Paul Swinney. We are here in our Bloomberg Interactive Broker Studio. Alex Steele's on assignment today. She'll be back mañana. We're also on YouTube, so head over to youtube.com and search Bloomberg Podcast Live. Our next guest I really want to get to because I believe she has a real unique perspective of what's happening out there in the markets. Barbara Goodstein joins. She's a managing partner. The firm is known as R360. She joins us via Zoom from Fort Lauderdale, Florida. John, at Fort Lauderdale, Florida today, sunny and 81. Just for those.
We're not too far
We're not too
behind.
far from that now. We're catching up with them. Barbara, thanks for joining us here. I'd love for you to just start by saying, what is R360? Who are your clients?
So it's a community for ultra high net worth people and their families. And these are people who have been very successful. They're worth an average of over $500 million. So it's a very a prosperous community, and it's a community that's dedicated to purpose and creating extraordinary legacies.
So given the background of your members, these are folks that have built businesses, have some wealth. What are they asking you about, or what are they discussing amongst themselves, I guess, these days?
Well, obviously, everybody's talking about what's happening in the markets. We have had what we're looking at now is a parade of all the different investment banks and all the luminaries coming in to talk to us and give us advice about what they think is going on. But everybody's interested at the same level about what they should be doing, how they should be investing, and how they should be planning for the future. Our members have a much longer time horizon, so they are not pressured to make decisions. They invest very thoughtfully, but they're also watching what's happening and very curious about the meaning of what's coming next.
What are their biggest questions? Are they differentiating this global macro shock compared to the GFC or the COVID-19 pandemic? How are they looking at this? You said long term, so in the grand scheme of things, this might just be a small blip then.
Well, it's not a blip, but it is probably in the long term not something that this group is going to start changing their diversification plan. So everybody here is very well diversified. They understand that they need to have protections against market shocks. And so they have the luxury of doing so. Something like a Bitcoin isn't sensitive to tariffs or recessions or PE ratios or China selling treasury bonds. So our group is very positive on Bitcoin, and we encourage people to have a certain percent of their assets in Bitcoin. So we have been very conscious of maintaining very well-diversified portfolios, and that comes into play right now as the markets are shifting and fluctuating.
One of the assets that actually has been performing well this year has been gold. Given that your members, they are diversified, as you mentioned, they do enjoy having a long investment horizon. How does gold fit in with most of the folks that you talk to?
Well, gold is another asset class that everybody here appreciates and values. And I think that we assume that most of our members have some small percentage of their portfolio in gold. So we, like in Bitcoin, is like digital gold. People are holding gold, they're holding Bitcoin. And now for downside protection, we're looking at hedge funds and hard assets. So this is portfolio insurance at this point.
With Bitcoin, when did you start looking at it? And what is the general sentiment around that? Do you find yourself having to convince them more of the Bitcoin narrative, or are they more averse? What is the general pulse?
So it's interesting because some of our members are among the original investors in Bitcoin. And in fact, some of them are consulting to President Trump on Bitcoin. So we're very fortunate to have such well-educated people in our midst. They've been educating the group for years already. And in fact, one of our members recommended to his group that they buy Bitcoin. I think it was like 10,000. So wow. Everybody's quite appreciative that we have people that are this well educated in our midst, and they have been very vocal and active, telling us all the reasons why Bitcoin has so much upside opportunity.
Yeah, just looking at Bitcoin today, off just a little bit, off about 0.5%, but still $93,000 per token. So it's had a nice run there in the last several weeks. Barbara Goodstein, thank you so much for joining us. Barbara Goodstein's a managing partner at R360. That is a group of wealthy families, and they talk amongst themselves about kind of opportunities, risks, and all that kind of good stuff. It's good to get a perspective of maybe a little bit different than just the general market here. So Barbara Goodstein, we appreciate her time. Let's head down to Washington, D.C., check in with Michael McKee. He is Bloomberg's international economics and policy correspondent. He flies to D.C. He doesn't take the train. He doesn't take my advice, but he does the flying thing. But he gets down there, and he does great stuff. Mike, we got some economic data today. I'm not seeing any cracks yet in the labor market. That's a good thing. Initial jobs claims kind of came right in line with expectations.
Yeah, we got the beige book yesterday afternoon, the Fed's collection of anecdotal evidence about the economy. Right. And it basically said that companies are making plans for layoffs if they need to, but they're not there yet.
Interesting.
And part of it is that people don't know what the ultimate tariffs are going to be, so they can't really model out how it's going to affect their business.
What about the IMF World Bank? Spring meetings are underway, and we have Secretary Scott Bessent saying that they serve critical roles, and we shouldn't really expect a wrecking ball or some sort.
Well, it's an interesting situation because during his interregnum between administrations, Donald Trump was quoted as saying he wanted to pull out of the IMF and the World Bank. Now, Scott Bessent is saying we just want to reform them, get them to focus on their original mission of lending and not get into things like climate change and gender equality and things like that. Not clear how the rest of the world is going to respond. The administration hasn't appointed any representative to the IMF or World Bank yet. So this is a situation that is going to be down the road, I think, before we get a clear idea of what the administration wants to do. The meetings this week are pretty much all about tariffs anyway. In every conversation that comes up, that's what people are talking about and how it's going to affect them rather than the IMF and World Bank itself.
Here we go. This is a red headline crossing the Bloomberg terminal. U.S. to demand Putin accept Ukraine's right to military force. This seems like a big piece of news as it relates to Russia and the UK, and we will have
more reporting on that coming up. So, Mike, just some more geopolitical news out there for you. And Mike, again, what's the feeling at the IMF about, these members? Do they feel like they can depend upon the U.S. as a trading partner, or do they have to prepare for maybe a new day here?
I think everybody is preparing right now. It's the only thing you can do because you don't know whether the United States is going to be there with you as a partner or across the table as an opponent. And so the thing that you hear over and over again is take care of your own, take care of yourself, make sure your policies are in good shape, make sure your economy is in good shape, and don't depend on the U.S., especially don't depend on the U.S. as the buyer of last resort, some person who's going to take in all of your exports, because now that may not happen. So we do see a cleaving, and the question is whether this can ever be repaired. And a lot of people I've been talking to here are worried that it won't be able to be fixed, at least not for many decades.
What is the collateral damage looking like to you, whether on the policy front or economic front? You did mention that it's basically looking out for yourself now, and that's not really how the global trade order or the global order that we want it to be work. But now it seems like it's really a regime shift.
It is a regime shift, and that's a problem for the United States because we have depended on free and open trade in our relationships with the rest of the world for a long time economically, and it's benefited people here in the United States. There have been downsides, certainly. The globalization of manufacturing hurt many communities in the U.S., but you can't really fix that through adding tariffs. So this doesn't put us in a good shape economically. And then because strong economic partners are good security partners, it puts us under the gun in national security as well, because we can't necessarily count on our former friends to partner with us on national security issues. Are the Europeans or other people going to join us in trying to restrain China and to keep sanctions on Russia, that sort of thing? So we lose either way, and that's what the general worry in Washington is. I heard some people last night say they don't think the rest of the country gets this yet, but they are very concerned about what has happened to not only the U.S. economy, but to our relationships with other people around the world.
Any changing thoughts on the Fed, Mike, what they might do, how they might move in response to what we're seeing?
No, well, of course, I spoke with Chris Waller, the Fed governor, today, and he basically said the same thing that everybody else has said, that they don't have enough information to make plans or to make to come up with views about what is going to happen to the economy. He said if the economy starts to slow, if we have a serious rise in unemployment, he would support rate cuts. He thinks that inflation is going to be a one-off risk from tariffs because you apply tariffs once and then prices go up, but then they don't stay up. In that, he's a bit of an outlier. But he isn't calling for any rate moves now either, and says it'll probably be July or later before we have any kind of clear picture of the impact that tariffs are having.
And what about, it seems like every day there's just a new headline, and that's really changing the Fed's position, the economic policy. How much are your sources telling you that they factor in, or are they more in a wait-and-see mode? Because you can't keep on changing your allocations or your stance or your views every day.
Yeah, people are very much in a wait-and-see mode. There are certainly professional traders who are trying to jump in and out on headlines, but the general feeling is there's nothing you can really do right now except wait it out, because you don't know whether any kind of tweet or any kind of remark to the press is then going to be walked back by someone in the administration one way or another. The president said yesterday that the Chinese were talking to us, and Scott Bessent, the Treasury Secretary, said, no, the Chinese are not talking to us. So do you place an investment on China? I wouldn't think so.
All right, Michael McKee, thank you so much. We appreciate it. Michael McKee, Bloomberg International Economics and Policy Correspondent. The news, again, crossing the tape here, geopolitical front. The U.S. will demand that Russia accept Ukraine's right to have its own army and defense industry as part of a peace agreement between Moscow and Kiev. The Trump administration also wants Moscow to return Ukraine's nuclear power plant, ensure Ukraine has passage over the Dnepr River, and return land occupied by Russia in the Kharkiv region. So it seems like some really big news on this front. So let's talk to somebody who knows this stuff. Nick Wadhams, he's a U.S. national security reporter for Bloomberg News. He is based in Washington, D.C. Nick, this seems like big news coming from the administration. Put it in context for us, please.
Yeah, I mean, the big thing here is that a lot of what we've been hearing so far out of the administration and the conversations between the U.S., Ukraine, and Russia have been a lot of demands on Ukraine. So we recently heard that the U.S. wanted to recognize Russian sovereignty over Crimea. They wanted to block Ukraine from getting NATO membership, a host of other issues, a critical minerals agreement. And that had provoked a lot of fears among European allies and critics of the Trump administration that essentially this deal was going to be really heavily favored toward Russia and Ukraine wasn't going to get anything in return. We are starting now to get some sense of what the U.S. is asking Russia, and what we know so far from our reporters' source-based work is that they are going to rebuff or push back strongly against this Russian demand that Ukraine essentially demilitarize. This has been a central war aim that Russia has made clear since the start of its invasion in 2022. And the U.S. is now saying, listen, we want to do this peace deal, and we're not going to let you get away with that. This is going to be something you're going to have to agree to. And then this energy issue, we know energy has been very important to President Trump. So the Zaporizhia power plant, a massive, massive power plant in Ukraine that Russia seized during the war, the U.S. is essentially saying, you got to give it back. So we now understand the U.S. is going to present these terms of a potential deal to Russia, and we'll see what the answer is.
And how do you think Russia will respond to that? Because the U.S. is demanding this military right force, but will Russia agree to it, you think?
I mean, that's the great question, and that's we're going to learn a lot about the viability of these negotiations. I mean, you know, the Russian idea that Ukraine essentially demilitarized was always seen as an extremely maximalist goal. I mean, it's hard to conceive of the U.S. or any other mediator basically acceding to the idea that a country be left totally demilitarized. I mean, that was something that you saw out of World War II with Japan, but otherwise this has not been repeated in modern history. So it would have been an extremely difficult demand to meet. The U.S. is saying essentially that's not going to fly. And, you know, I think what we'll see is, depending on how Russia responds, we'll have a better sense of whether they see these negotiations as a viable path toward an actual ceasefire, or whether they have no interest in peace and are just going to press ahead with the war. So we should have a strong indication of that in the next few days when President Trump's envoy heads to Moscow.
Nick, is there any sense as to what kind of leverage the U.S. has here on the campaign trail? Candidate Trump at the time was very confident about his ability to get what he termed a good peace deal negotiated quickly. Do we have the leverage to actually do that?
Well, I mean, the U.S. definitely does have some points of leverage. It also has some weaknesses. I mean, the big leverage it has, obviously, for one thing, is the sanctions, the massive sanctions regime that have essentially choked off the Russian economy, separated it from the West. Though Russia has been able to keep its war machine going, the economy is in pretty grim shape. And the U.S. could just keep up with the flow of weapons and support to Ukraine, you know, under the idea that, hey, like Russia, they did this invasion in 2022. They've taken over about a fifth of Ukraine's territory, but they did not topple President Zelensky's government as they had hoped, and Ukraine doesn't seem to be going anywhere. So the U.S. could certainly exercise leverage in those ways. Russia, though, also sees that it has its own leverage. Trump does not want to give Ukraine the amount of military aid that it's gotten so far, and they have made battlefield gains in the last several months. So in some ways, for Russia, there is a continued interest in prolonging this thing and drawing it out, and hope that President Trump turns his ire again toward Vladimir Zelensky rather than toward Russia. That whether that's a gamble they're going to be willing to make, though, is another question entirely.
All right. Fascinating development here. Nick, thanks so much for your time. We appreciate it. Nick Wadhams, U.S. national security reporter for Bloomberg News. He is based in Washington, D.C. And again, the headline crossing the Bloomberg terminal and a significant shift in this story in Ukraine. U.S. to demand Putin accept Ukraine's right to military force. So we'll continue on that reporting throughout the day. Right now, let's get a reset here. We'll go to John Tucker for a Bloomberg Business Flash. John.
The major stock averages are higher for now. A theme investors seem to have latched onto is the idea the Fed's going to cut rates sooner than expected to keep the economy from spiraling into recession. Several companies, including Texas Instruments, American Airlines, and PepsiCo, they've lowered their earnings outlooks or withdrawn them altogether because of uncertainty surrounding the tariffs. S&P 500 up 70 right now. The Dow up 256 points. The NASDAQ 100 up 365. Amy Wu Silverman at RBC Capital Markets says more investors have been seeking downside protection.
It's certainly been incredibly tumultuous, and I think that's why even since the beginning of the year, you've seen this dramatic uptick in folks who want to use the options market for protection, buying S&P puts, hedging overall, looking at VIX options.
Walmart doubling down on discounts. The retailer rolling out managers' special signs. They're calling out price cuts on key items across departments. This according to a document seen by Bloomberg. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Isabel and Paul.
All right, John Tucker, thank you so much. We appreciate that. Isabel Lee, she's sitting in for Alex Steele. I am Paul Sweeney. We are live here in our Bloomberg Interactive Broker Studio. We're also streaming live on YouTube. You can head over to youtube.com, search Bloomberg Podcast Live, and that's where you'll find us. I'm looking at just some volatility gauges here today. Of course, we quote the VIX all the time, and it's at 27 and change right here. Anything above 20 kind of gets your attention. Above 30, you're like, uh-oh, something's going on out there. And likely in the fixed income business, you got the MOVE index. That's up 40% just this year, although it is off its highs. But lots of volatility out there, folks. A lot of uncertainty coming out of Washington, D.C. I want to talk to a pro about prepped into the economic discussion really in the last 3 to 4 months as the tariff rhetoric has really escalated coming out of Washington, D.C. I want to talk to a pro about how you kind of approach markets with that backdrop. Barry Ritholtz joins us. He's a host of Masters in Business on Bloomberg Radio. He talks to so many of the leading business folks and financiers out there with his podcast, The Masters in Business. He's also the founder of Ritholtz Wealth Management, so he does this stuff for a living as well. Hey, Barry, how do you just get up every day, you turn on your Bloomberg? How do you approach this stuff with all the volatility that's out there?
So, putting capital at risk in the markets is always about matching a future need, or technically a liability, with present capital. And so if you're saving money for your kids, college, you're putting money into a 529, or your own retirement in 10, 20, 30 years, you just have to remember that we're not stuck thinking about the day-to-day. No one is judging you by your market performance this week, this month, this quarter. And it's when the news flow is this overwhelming, when the amount of headlines and policy changes and, it's really easy to get caught in that maelstrom. It's really useful to just step out of yourself, step out of the moment and say, when do I need this money? Hey, if you need the money in the next 12 to 24 months, well, then you have every right to be concerned about all this volatility. But if you don't need this money and we just had a conversation with an endowment that's perpetual and literally doesn't need the money for forever, then who cares what happens in a random Thursday? It's not meaningful to their long-term performance.
What about, based on the sources that Paul and I have spoken with, and I'm sure many are saying that they're just staying on the sidelines or staying put. But do you think this decision paralysis all this uncertainty will drive the U.S. to a recession?
So, it's funny. I'm a big fan of Torsten Slok. I've had him on the podcast a few times. He started the year 0% chance of recession. Yeah. All right. Now he's at 95% chance of recession, assuming that we don't walk back these tariff measures, where there's lots of signs where we're seeing that. So there's always, since 1950, we've had a recession just about every 4.5 years on average, even though we really haven't had one in 15 years, 30 seconds during the pandemic. But other than that, you got to go back to the financial crisis. So there's always a recession coming. The problem is markets are really good at sniffing out the impact of a weakening or contracting economy. And by the time we realize we're in a recession, market's already down 15, 25, 30%. It's too late to do anything. And the flip side of that is always so amusing. Markets bottom when the headlines are terrible, right? Just think about how far we're off of the lows here and how bad the headlines were when that happened. Go back to the financial crisis or the pandemic. The headlines are awful. So, yeah, recession's coming. There's always a recession coming. But what can you do about it? The fascinating thing to me was that Wall Street got so excited when the president was elected because the assumption was, hey, extension of tax cuts, deregulation, business-friendly environment, let's have a party. And instead, when the market said, oh, he's serious about these, really 1930-like Smoot-Hawley tax cuts of 100%, these aren't just negotiating tactics. That first 15% drop in equities, 10% in 2 days, was the market saying, this is going to slow the global economy. This is going to slow U.S. economy. It's going to shave up a couple of percentage points off of GDP, off of corporate revenue, off of profits. We were anticipating a much more robust economic expansion. We're changing our perspective. And ultimately, what we've been seeing happen, this little bit of a recovery we've enjoyed the past week or two, has been, oh, so is he going to walk this back? Should we take him literally? Should we take him seriously? Markets are still trying to wrap their head around it. I never thought I would say this, but thank goodness for Treasury Secretary Bessent. He seems to be the person with Trump's ear who's saying, the stock market and the bond market has voted, and we know Trump really pays attention to the stock market, and you're getting two big thumbs down. If you keep going down this path, you're going to be Herbert Hoover. And I think that's what allowed him to kind of walk back the most radical of the tariffs we've seen.
Yeah, Bessent may end up being kind of like the Gary Cohn of the first Trump administration.
That's exactly who I was thinking of.
Yeah, a little bit of a voice of reason
precious
there,
to pick that up.
Yep, interesting. All right, Barry, always love getting a few minutes of your time. Really appreciate it. Barry Ritholtz, folks. Masters in Business, a fantastic podcast. I think it's our most popular podcast coming out of all of Bloomberg, so check that out. He always gets great guests talking about the markets and kind of how you should be thinking about things, really gets you thinking. So he's the host of Masters in Business on Bloomberg Radio. He's also got a day job. He's the founder of Ritholtz Wealth Management. They manage money. And as you probably heard from Barry's comments, and he's been consistent on this, very, very long time horizon. He doesn't get spooked very easily. The market's kind of bouncing back again here today, third day in a row. So we'll take that. The S&P up 70 points. That's 1.3%. The Dow's up 250 points. And the NASDAQ's up 300 points. That's 1.8%. So pretty solid across the board. Even the small cap names, they're up over 1%. The Russell 2000 yields coming in slightly. 10-year Treasury, 4.33%. So we'll keep an eye on these markets. More Bloomberg Intelligence coming up in just a moment. This is Bloomberg. Good morning.
is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, Isabel Lee, Paul Sweeney. We are live here in our Bloomberg Interactive Brokers studio. Alex Steele, she is on assignment in the oil patch. She will be back tomorrow. We're streaming on YouTube, so head over to youtube.com and search Bloomberg Podcast Live Podcast, and that's where you'll find us. Mandeep Singh joins us, Senior Technology Analyst for Bloomberg Intelligence, here in our studio. Alphabet's going to report results. The big issue for me is I could see AI, ChatGPT, whatever the other ones are, really damaging Google's core search business. What do you say to that?
Well, so when you look at the past 5 or 6 quarters of the search segment growth, it's been, high single digit to low teens. And the makeup of that has been ad pricing contributed, low single digit growth. The ad impressions, the total paid clicks, which is your user growth, volume growth, contributed high single digit. That has reversed in the past 2 quarters, and I feel that trend is going to continue. Ad pricing is the bigger driver now. It's growing high single digit, whereas the volume user growth has slowed to low single digit. And what that tells you is ChatGPT is taking a share in terms of the volume of search queries, but Google is able to offset that with better ad pricing growth. I mean, think of it as a tool.
How long can that go? I like pricing power, don't get me wrong.
Yeah. Well, it can go on because the way ChatGPT monetizes its engagement is with a subscription model. Right now, they are not monetizing it with ads. So if you're an online business, you have no choice but to spend on Google ads, even though ChatGPT is getting engagement, it's got user traffic. But if you're an online business who wants customers for your business and you want to show an ad, it's just Google, Meta, and Amazon. So even though Google is losing some traffic, they're able to charge more for the ad that they're showing. And I think
these guys.
It's still, I mean, they are still insulated from all the pullback in advertiser spending because they have the highest ROI when it comes to ad spend. There's no other place where you have a higher ROI per dollar spent on ads.
I'm looking forward to this because it will really set the tone for the big tech, and I feel like everyone's feeling a little jittery. What about the cloud unit? Isn't that the clearest indicator of how AI will continue down the line?
Yeah, so that is where the diversification element plays in for a company that generates over $350 billion in annual revenue. So clearly they have this sizable business, $50 billion run rate. The problem for Google is even though that business is growing almost 30%, in terms of profitability, it's such a small amount compared to what search contributes. The margin profile of cloud is like much inferior than the overall search business. So that's where, if it was an independent business, Google Cloud would fetch a very high valuation. Wow. But because it's part of the Google entity where search is the key driver of profitability, it still doesn't get as much attention as search does because of the profitability aspect.
What's investor sentiment on Google these days? Positive, negative? I'm just looking at the R&R function. Still 60 buys, 15 holds, no sells.
Yeah, and this is the least, I would say, in terms of buys. So if you go back in time, it was much higher in terms of consensus buy. And look at the multiple. I mean, when you compare Google's PE or take any other multiple relative to other Mag 7, this is the cheapest company in terms of multiple. And it's been like that for the past, I would say, 12 months because of the ChatGPT effects, slightly because of the regulatory headwinds, the Chrome divestiture that has been in the news. But look, if search performs, and search grew double digit last quarter, and they are able to offset that with Gemini and, the LLMs that they have a lot of things going for them on the chip side, the cloud side. So it's just a matter of calming down the fears about search being vulnerable to ChatGPT.
How can they do that, do you think? If you were advising them, what would you say?
Just AI overviews. I mean, they've rolled that out. That's an AI product. Make sure you show the engagement of how they are monetizing AI overviews, because one of the fears is AI overviews doesn't monetize as well as the traditional blue links.
And we know that Google faces regulatory pressure. How much do those actually affect sentiment?
I mean, look, when it comes to Chrome, if you are talking about deploying large language models, Gemini, that is where you do it. So if they lose Chrome, if that has to be divested, suddenly Google will become vulnerable to all sorts of competitive attacks. So Chrome to me is at the heart of them deploying Gemini and LLMs. And that is a very big case that's going on, the monopolization trial, where the remedy is to divest Chrome. And Chrome is crucial, 3 billion plus monthly active users. Even though it doesn't generate direct revenue, the impact of that is huge.
What does Jen say about Jen Rhee, who's our antitrust analyst at Bloomberg Intelligence? She's the one I need to.
Yeah,
talk.
I mean,
so what is she saying?
Right now, she's of the view that the base case is it's not going to be divested. They will be able to come up with a remedy to appease the regulators. But with these trials, you never know.
What's the timing of this?
It's still going through this phase where there is a hearing going on. They lost the case. Now it's about remedies, and it may, I think, take another few months before we hear the final outcome.
You had to have some intestinal fortitude to step in front of that thing. Because, I mean, I don't know. All right, Mandeep, that's your job. That's what we pay you for. Mandeep Singh, he's a senior tech analyst at Bloomberg Intelligence. He is, along with Anurag Rana, leading our global tech research. And, folks, you have to have a global view on technology. You have to have boots on the ground in Asia. You have to have boots on the ground in North America and Europe. We do at Bloomberg Intelligence, and that's why our technology research is some of the best on Wall Street. So check it out, BIGO. On the function. Isabel Lee, thank you so much for sitting in. I think we're going to free up tomorrow. I think Alex will be back. But we've got Balance of Power with Joe Matthew. Boy, he's got a full plate here coming up. He's down in Washington, D.C. That coming up right after Global News.
This is CBS News on the Hour, sponsored by Steel.
I'm Deborah Rodriguez. We begin in Illinois, where the man who admitted to a shooting 7 people to death at a July 4th parade in 2022, has been sentenced to 7 consecutive life terms. The judge pronounced 24-year-old Robert Cremo irretrievably depraved, permanently incorrigible, irreparably corrupt, and beyond any rehabilitation. His victims ranged in age from 8 to 80s. President Trump lashing out at Vladimir Putin after overnight attacks that killed at least 12 people.
In a post on Truth Social, President Trump wrote, quote, "I am not happy with the Russian strikes on Kyiv. Not necessary and very bad timing." The post goes on to say, "Vladimir, stop. 5,000 soldiers a week are dying. Let's get the peace deal done." This criticism follows a Russian airstrike against Ukraine that killed at least 9 civilians and injured more than 70. The attack happened even as the president criticized Ukraine's President Zelensky, saying it was tougher to reach a peace deal with him than it was with President Putin. Linda Kenyon, CBS News, the White House.
The president's not happy with Beijing either for backing out of a deal to buy U.S.-made aircraft. CBS's Michael Wallace.
Trump posted on social media that Boeing should default China for not taking the finished planes it committed to buy. He says it's just a small example of what China has done to the U.S. for years. Boeing says more than 50 new planes were headed to China, but China is refusing to take delivery as the trade war heats up. China has already returned a few planes.
The Trump administration asking the Supreme Court to allow enforcement of the president's ban on transgender people in the military while legal challenges move forward. Loyola law professor Lori Levinson.
There had been a court below that said that executive order should be put on hold and that people should be allowed to serve even if they're transgender. But now the administration has run to the Supreme Court on that issue as well.
The Vatican says tens of thousands of people have passed by Pope Francis' coffin in St. Peter's Basilica. No word yet on when a conclave will begin. Austin Ivory reports on the church.
Inevitably, some of those cardinal electors are not yet here. We had this morning in the meetings that the cardinals are holding every day, 103 present, which means more than 2/3, so they can proceed with making decisions. But we will see in the next few days, in the lead up to the funeral on Saturday, more arriving. There are various reasons why cardinals can't come straight away.
New report from Who's Heritage finds that despite growing efforts to remove them, more than 2,000 Confederate symbols still stand throughout this country. Dow up 268. This is CBS News. rumors are spreading about the Pope and a quote being attributed to Bob Dylan.
Many people posted this quote online, attributing it to Dylan. Pope Francis was a voice of mercy in a time of noise. He walked with humility, spoke with fire, and dared to love the unloved. He reminded the world that compassion isn't weakness, and faith doesn't have to shout to be heard. May he rest in the eternal peace he so often preached. But CBS News confirmed says there's no evidence Dylan ever said that.
The Bob Dylan?
The statement hasn't been